I think Anushi will be a better judge there, but the key highlights is the margins have come at much better than what was expected. It has come to around 20% and overall order book growth is also much better than expected. We have Anushi also joining in to give us more details on that since she tracks this very closely. Anushi, give us the details.
Right, so what we are looking at for ABB Global is what is a clear standout, as you've mentioned, is firstly the EBITDA margins. Now we are looking at a number of 20.2%. The expectation was for overall margins to be in the range of 19.1%, see about 80 basis points of a decline, but in fact it has recorded better than expected margins over here, so that is definitely something that we are seeing. India order growth also, if we see of the company, the context in terms of how the ABB India growth story is in terms of order inflows, they have reported a 1% of a growth. The expectation was for a negative growth for the quarter, so that is also another positive that we are seeing, and management commentary on the same would be important to how the ABB India order flow business could pan out in terms of where the order picture is concerned. If you look at the overall orders of the company, that stood at about $9,213 million, which is a 5% of a growth compared to last year. Revenue also saw about a 3% of a growth, while revenue we did see a little bit of decline, because the expectation was that the revenue may grow in the mid-single digit range as per the last quarter outlook given. The Bloomberg expectation was to see about a 3.9% of a growth. So it is majorly in line with that estimate that we are looking at. Now do note that the outlook for CY25 for the company remains that they plan to maintain a positive book-to-bill ratio. Along with that, they expect the revenue growth to remain in the mid-single-digit range and operational EBITDA margin to improve on a year-on-year basis, as we have seen in the first quarter. So that is the overall context that we are seeing for ABB Group.
Okay. All right, Anushi, thanks so much for that. And you're looking at the intraday chart, it's up about 3% or thereabouts. Let's get our experts on for the day. We've got Kush Bora of kushbora.com as well as Shahina Mukaddam joining us this morning. Thanks so much as always for the two of you for joining in. And happy Thursday to you. I would normally say happy Friday, but today I'm saying happy Thursday. Incidentally, let me go to the first call of the day because he's called at a very opportune time. Dheeraj, thanks so much for calling us, and you bought ABB at 5525, not too far from the current market price. When did you buy it, and what is the outlook that you have?
Yeah, I bought it 10 minutes ago. Sir.
Oh wow, okay, fine, all right. So what do you want to know?
Can I add more at current levels is my query, or should I exit within a month, or what's the outlook, overall outlook of ABB is my query, sir.
Okay, so but then if you have an outlook on the business and you bought it for fundamental reasons, why are you looking at only 1 month? I'm just curious.
Actually, for a short-term swing, sir, as it posted good result, I wanted to...
You wanted to benefit from that. Okay, I get it.
Yes.
All right. So this is not a long-term fundamental view that you're seeking. Anyway, let me address both, right? Shahina, I'm sure that you caught the numbers that Anushi just spoke about, and I'm sure that you've been tracking this stock as well. So first, let's look at fundamentals, and then I'll come to Kush on ABB on the charts. What do you make of it? Should you hold on?
Well, if you're a long-term investor, you can hold on. But if you want to add, I would believe you should add at lower levels. The numbers were very good. Margins are expanding quite well. And I believe even the order book is doing well. So they have got good order book. They've got good products. They're targeting the high growth and also the higher margin products. Having said that, I would just say add at lower levels because valuations, despite everything, is still very expensive. If you look at the price to book, it's almost above 1 year forward, it's about 14-15 times. And also if you look at the, EV by EBITDA is also very high, and even the P is very high. So given all these expensive factors, better to add at lower levels.
Okay. All right, let's talk about those levels then. And if you've got a time frame of 1 month then, Kush, and you bought at 5525, you've already seen a bit of a pop. What are the key levels to watch out for on the upside?
Hi, Alex. Hi, Shahina. I think this has to be one of the first, right, Alex, where you put a live trading query. And by what do I mean by that is that the trade actually happening on this show. So that is fantastic, right? So I think this is a good buy. I would have ideally preferred to buy this above the 5600 mark, which was a recent swing high. And once it crosses that, there will be completion of a rounding bottom formation. But good to see that he's already bought it and he's in the money. Now what he could do is hold this with a stop loss around the 5350 mark. Once it crosses 5600, I think the supply pressure of the last about month and a half, 2 months will get over and the stock could move higher to 5750, perhaps even 5825 kind of levels. So suggestion would be to hold, keep a stop loss around the 58, 50, 53, 50 mark. Don't add right now. Once you see it crossing 5600 and building on from there on, that's when you should add more and hold till 58.25 level.
Okay, so that's the view with regards to where charts are concerned for ABB India. Our next question is from Puneet, who's writing in from Delhi. His question is on RVNL. He's bought 1,550 shares at 598 a piece and sitting on a significant loss of around 3.6 lakh rupees right now. And he's stuck since July is what he's saying. And he wants to know what should be the next course of action. Shaina, I'll come to you on this one. Fundamentally, how are you viewing the stock? Railway stocks have been beaten down, but they have picked up in the past few weeks or so. What's your view with regards to RVNL? Should he book some losses or should he wait to recover them?
I think he should hold RVNL. They have again here a good order book position, and what I believe is that it's a public sector. It's pure play into with 50% over in terms of engineering. The order book is more than 65,000 crores. So while it is slightly expensive, and also the stock had given you a good return if you look at a slightly longer term period. But I believe given the order book position, given the execution improvement that is likely going forward, one can continue to hold at current levels.
Continue to hold at current levels is the view coming in on RVNL. Our next caller, Viral, is calling in from Mumbai. A very good morning to you, Viral. How can we help you?
Hi, good morning. So I have a stock called Valor Estate. So I wanted to know the fundamentals of the company, price targets, and what do the analysts think about its future.
Okay. Viral, if I'm reading this correct, you're holding around what, 3.9 lakh shares at 116 a piece. Is that correct?
This is correct, yes.
So you're sitting on a profit of 3 crores already right now?
Close to, yes.
All right. So you've already studied the fundamentals, if I'm not wrong.
You could say that, yes.
All right. So first of all, I would say congratulations on that. That's a significant amount of profit that you're already sitting on. I'll take this up with Shahina. Shahina, 3 crores is not a small profit, and especially right now we're seeing a volatile market overall. What's your view with regards to Valor Estate? Should he book some profits at the current level, or should he continue to hold?
See, what I see the numbers is that after a long period of losses, the company, it's a real estate company. So they have actually turned around, and we saw in the last quarter, they have made profits. The stock seems to be pretty bullish. It's about a 10,000 crore market cap. So it seems to be pretty bullish for the shorter term. Numbers could be good, coming in good. I just want to give a negative out here that you need to keep a watch on. The promoter holding has come off over a 1 year period. Secondly, there are huge amounts of, there's a lot of pledge. While the pledge has reduced over a period of time, so there seems to be some turnaround. But really, you need to keep a watch on this. Otherwise, the stock looks like a hold even at current levels.
Okay. Viral, you're still with us. Can you help me understand what the thinking was? Because you've gotten at the absolute perfect level if you think about it. We pulled up the 1 year chart. And on a 1 year basis, it's actually negative, but you've gotten in at a very key level. What was the thinking when you did, and how did you take such a large bet? What did you think of, or what drove you to take such a large bet?
Correct. No, so actually I've been buying since 2018. So I have been buying since 3 rupees 50 paisa.
Oh, okay.
And I have been consistently buying since it was 350, 4, 6, every level you could imagine, every price I've bought up till 230 levels. So the thing is, we have a huge, land bank. Basically, so if you see, they hold about 250 acres of land bank in Mira Road, and just next to the station. And if you really do the calculations, it's debt-free land in residential zone. So only that land is worth 6,000-7,000 crores. So, and apart from that, they have got massive build-up of 5-star hotels. So if you see the Delhi 5-star hotel, if you see their 50% stake, that itself is worth 4,000 crores. Yeah. Right. So 2 projects, just a land bank is 10,000 crores, plus a lot of construction happening in BKC and South Mumbai, so massive land bank. So that's the reason why I bought it.
Okay, so fair point. And by the way, in case people are not aware, we're talking about DB Realty, which is now called Valor Estate. But Viral, now that you made this kind of gains, and you don't have to answer this, but I'm just curious about this, right? Because you've accumulated over a period of time. This is a very sizable holding. What percentage of your portfolio does this account for?
Probably 50%.
50%, okay. Okay, all right. So, and if the view is on the technicals to take some money off the table, you'd be willing to do that?
Not really.
Okay, but let me still go ahead and give you some perspective. Kush, do you want to weigh in on this? Based on the kind of run-up that you've seen from lower levels, it's moved up very quickly. If I saw the chart correctly over the last 3 months or so, what do you make of the current levels, and what is the potential for upside?
Firstly, Alex, I must say that you often invite us, China, myself, and some experts on the show, who take the conversation higher. This time it's the guest. Kudos to Viral for taking the level of the entire conversation to a different level, and of course on the gains that he's making. Now, I'm not very constructive on the entire real estate space. In fact, if you've heard me for a while now, the other ones, the DLF and the macro tech of the world have been reeling under pressure. The rise has been taken as an opportunity to sell. I must say though that Valor Estate actually stands out, from the entire pack. The reason being that if you see, the last about month and a half, 2 months, there has been a good accumulation incidentally around his average price. I can't call it buying price. He started at ₹3, but around his average price of 120, 118. From there on, the stock has moved higher. From a near to a medium term perspective, the stock's actually broken above all the resistance levels. So at least the moving averages. The next one coming up is at 202. If that level is taken out, I think the stock is poised to move higher, perhaps 235, 250 as well. My suggestion would be to continue to hold anyway. He doesn't look like in a hurry to sell. So not a bad idea to continue holding on to this one. But I'm a fan of stop losses or trailing stop losses at least. So I would go ahead and still recommend one to him close to the 170 mark. If that is broken, perhaps taking some money off the table might make sense. But yeah, as I said, this one stands out from the real estate.
All right, so that's the view with regards to where charts are concerned for something like a Valor Estate. Moving on to the next question, Suman Prasad is writing in and he wants to know, he's from Noida and wants to know a view on Geo Finance. He's holding 1,300 odd shares at an average price of 355 a piece. Shaina, I'll come to you on this one. A lot of people have invested in this counter and are sitting on significant losses. Should they continue to hold or book losses? Because he's sitting on a loss of roughly 1.5 odd lakh rupees.
He should continue to hold. It's of course a very well-known management, and the growth is likely to come in. They're expanding their business, likely to launch their mutual funds. They're getting very aggressively into loans, even the small ticket loans. They have got it's smaller in terms of base as of now, but the potential for growth is good. So one can continue to hold if you're a long-term investor.
So that's a view on Geo, and quite a lot of value erosion, but the stock has made a bit of a comeback, up about 10% as you can see over the last month or so. Ajay is calling us from Ambala. Hi Ajay, good morning to you, and how can we help you today?
Yeah, good morning sir. Good morning ma'am. मेरा क्वेश्चन फेलो वर्ल्ड के ऊपर है. एक्चुअली लास्ट टाइम मेरी बात हुई, कुछ सर ने कहा था कि 580 के आसपास आए तो बेच देना. मेरे पास 1200 शेयर्स हैं 730 के आसपास. तो सर क्या मैं इसको बेच दूं कि अभी रखूं? आज 4% अप है.
4% अप है. और आपका टाइम फ्रेम क्या है अजय? आपने जब खरीदा था?
मैं रख सकता हूँ, मैं 6 मंथ साल रख सकता हूँ, ऐसा नहीं है. मतलब मेरे पास 1200 है तो कुछ बेच दूं क्या, वही पूछना था.
Okay, understood. Kush, you want to weigh in on this? If he's got a relatively short-term time frame, he's made a bit of a recovery, but what are the key levels to watch? Where would you put the stop loss?
So I prefer to answer this one in Hindi, as he's asked the question in Hindi. That's all right. So Ajay, first up, thank you. आपने ये याद रखा कि क्या levels हमने यहाँ पे डिस्कस किए थे. अब देखिए जो 580, 590 वाला जो रेजिस्टेंस जोन था, अगर आप देखें तो अभी भी वो स्टॉक पे एक्ट कर रहा है, क्योंकि स्टॉक ने अभी रिसेंटली जो हाई बनाया था वो 600 के आसपास का था और फिर से स्टॉक उसी लेवल के आसपास आ गया. मेरी सलाह रहेगी कि बिकॉज स्टॉक में अब पिछले 3 सेशन से मोमेंटम पिकअप हुआ है. अगर आप आज का वॉल्यूम्स देखें तो दिन में करीब 1-1.5 घंटे का समय ही बीता है, लेकिन अभी भी इसका अगर आप वॉल्यूम्स देखें तो पिछले 20 दिनों के एवरेज से ऑलरेडी 2 गुना वॉल्यूम हो चुका है. तो हो सकता है कि यहाँ पे मोमेंटम जो है ये पिकअप करे. तो अब मैं ये सजेस्ट करूंगा कि रादर देन इसको अभी आप थोड़ा सा ऑफलोड करें, इट विल बी अ गुड आइडिया टू होल्ड दिस विद अ स्टॉप लॉस जो कल की जो क्लोजिंग थी उसके आसपास. तो 560 का ट्रेलिंग स्टॉप लॉस लगा के चलें और पार्शियली जो आपकी क्वांटिटी है उसको इस स्टॉप लॉस से होल्ड करें. अब ये मोमेंटम जो है बिल्डअप हो रहा है. 580, 590 का अगर ये रेजिस्टेंस क्रॉस करके उसके ऊपर की क्लोजिंग देता है तो यहाँ पे आपको 625 से लेके अबाउट 660 तक के लेवल्स भी देखने मिल सकते हैं. तो मेरी सलाह रहेगी कि इसको ट्रेलिंग स्टॉप लॉस के साथ होल्ड करें, बिकॉज अब इसमें वॉल्यूम एक्शन भी पिकअप हुआ है, प्राइस एक्शन भी पिकअप हुआ है और मोमेंटम भी बिल्ड हो रहा है.
View with regards to Cello World, just a quick context. Cello World is up today on the back of a Kotak note. In the Kotak note, they've given a target price of 710. What Kotak believes is that the correction is overdone now. The stock has been down around 35% in the past 6 months, and they're expecting a 12% EPS CAGR on this particular counter. They're also expecting growth to recover, and this will be on the back of consumer sentiment seeing recovery as well. And they don't see any major demand challenges for something like a Cello World. So that is the major reason as to why the stock is up almost 4% in trade today. All right, moving on to the next counter and caller. Venkatesh is calling in from Bengaluru. Venkatesh, a very good morning to you. How can we help you?
Yeah, good morning, ma'am.
Good morning.
Yeah, so I've got around 28,000 shares of LIC, which I had purchased at 1,070, 1070.
Okay.
1 year back.
Okay.
Shall I hold or shall I dispose it off and switch over to some other company?
Okay, got it. Venkatesh, I just want to understand, because you're sitting on a significant loss right now. What was the thinking when you bought LIC, and how long ago did you buy LIC? Because you've bought it at elevated levels.
Yeah, 1 year back.
1 year back, okay. And you would want to continue to hold it from a longer term perspective, fundamentally?
Yeah, because it is safe is what I feel.
Okay, all right. And since this is 28,000 shares, what percentage of your portfolio is this exactly?
What is that? I didn't get it.
What percentage of your portfolio right now is LIC?
90%.
90%. Okay, that's quite a significant amount of your portfolio. Shaina, I'll come to you on this one. He's sitting on a 75 lakh rupees loss right now, almost 76 lakhs. And that's 90% of his total portfolio. First of all, Venkatesh, just to give you a view, it's not advisable to have such a big amount of portfolio concentration in one particular stock, and I think Shaina will also agree to that. But Shaina, what's your view? Should he continue to hold, wait for some recovery?
See, just purely on LIC, of course, I totally agree with you, Mahima, that one should not have such a huge percentage of your portfolio in a single stock. Even despite it's something like an LIC, which is fundamentally strong to hold for the long term, basically because it sort of, keeps your overall portfolio return in a stagnant basis if the stock doesn't perform for, say, a 1, 2, 3 year period, which sometimes happens for large cap stocks like LIC. So having said that, I think if I'm just discussing LIC by itself, you can continue to hold at current levels. I would say keep a stop loss of 700 rupees, but hold, because your valuations are very attractive at current levels. It's just about 0.7 times FI27 EV. So one can continue to hold. And also in terms of growth, new expansion in terms of verticals, they are likely to expand. They are looking at other segments in terms of growth going forward. Government is giving them other areas in which they can operate. So to that extent, it's a hold. But yes, you need to diversify your portfolio. You can actually diversify to something like a large cap bank, ICICI Bank, HDFC Bank. So you can switch part of it, book part of your loss, switch to one of those banks, say ICICI Bank. So there you have that potential for diversification as well as in quality stocks.
I'm just to follow up on LIC, since it's a very large holding that Venkatesh has. There are a few headwinds that the sector as a whole is facing, right, Shaina? So when we're talking about bank assurance and the way that these products are sold, and we're talking about the construct of their policies that they sell, and we're talking about the need to increase term loan contribution because it's a higher margin product. How do you see these things affecting earnings, if at all, in the current financial year? And from that perspective, what is the potential for growth for LIC that you see? I agree that valuations look attractive right now, particularly if you consider the kind of portfolio that it's sitting on. But in terms of growth potential, how much would you attribute to LIC?
I think the impact of the changes of the government policy on LIC will be quite marginal compared to the others in the segment, and they all are finding ways to actually overcome it. There are limitations that the government is putting on various factors. They've already started, like on expenses. At the same time, I think the opportunity for growth, given the market size, and also LIC expanding into other areas in overall insurance segment. So there is potential for them to do better. And I think the overall market market construct also seems to have bottomed out. If you look at the overall, the negativity sentiment that was there, because whatever China negative is positive for us. So to that extent, we seem to have stabilized in the overall market, and LIC does have huge holdings across quality stocks. So to that extent, I would say you can hold. But yes, you can, as I said earlier, you should switch actually, partly just to diversify your portfolio into quality stocks in other sectors.
Yeah, Venkatesh, hopefully this views helped you out, and I guess to a certain extent when you're buying LIC, you're buying the portfolio of stocks also that they hold, if you can stretch the argument that way, but then that's not the ideal way to hold a portfolio of stocks. So bear that in mind, and I hope that this conversation has helped you. We have to slip into a very quick break. We will take more questions on the other side. Viewers who've been waiting by, thanks so much for your patience. We'll be back to take more of your questions, so do stay tuned.
That's huge. That is a biggie. It's out of it.
Gold Plus Clear Glass. Far ho ya near, sab kuch dikhe clear.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Welcome back. You're watching Ask Profit, a show that gets all your stock-related queries answered, whether they're fundamental or technical. For viewers who are just tuning in, you can either call us or WhatsApp us on the numbers that are flashing on your screen right now. All right, moving on to the next query. Ram from Dublin is writing in. He's holding 2,500 shares of Tata Power, bought at 65 a piece, and sitting on significant profits of around 7.9 lakh rupees. He wants to know whether it's time to sell and book profit, or should he continue to hold? Shaina, I'll come to you on this one. Tata Power is the counter. What's the view like? Should he continue to hold?
Yeah, you should continue to hold at current levels. Tata Power has actually expanded a lot and is doing pretty well in the renewable energy space. They have got a couple of new initiatives, including nuclear power. So I would believe at current levels, it's a hold.
Hold is the view coming in on Tata Power where fundamental is concerned. Our next caller, Ravi, is calling in from Visakhapatnam. Ravi, a very good morning to you. I believe you have a query on MRPL.
Yes, ma'am. Yes, MRPL.
Okay, go ahead with your query. What's it about? Have you seen the fundamentals of the company or the technicals?
Yeah, fundamentals I've seen, and I bought at 230 rupees, ma'am.
Okay.
So I found, overall the petrochemical sector is also lucrative.
Right.
But unfortunately, with this Trump flow, from 232 it's going to 105, and later it covered to 130. Now I'm sitting on loss of 50k. So what is the view should I take? I'm ready to wait actually. I'm a long-term investor.
Got it. Got your query, Ravi. I'll come to you again, Shahina. Mangalore Refinery and Petrochemicals is the counter. What's the view like? Should he continue to hold? He's sitting on a loss of 47,000 odd rupees right now.
Well, I think he can hold for now and look for a bounce to exit. There's a lot of uncertainty in terms of oil prices. Oil prices as of now are low, but at the same time, what is going to be happening to their ability to actually continue to sell at current levels, or will they have to see price cuts going forward? So to that extent, it's a hold at current levels, but he can look for a bounce to then look to book some profits of his. I think he can look for something close to about 150 odds for him to take an exit.
Okay. All right. We have a viewer who is saying or is asking, did we stop the YouTube live on NDTV Profit? It's live. It's available. In fact, please do check it out. And we can maybe take some of the questions from there as well. But you got a next question, Javinder, who's writing in from Punjab and asking about Canara Bank, which he's bought at levels of 110, and he's sitting on a sizable profit. No. Okay, this is seemingly the wrong. Okay, that's the wrong play that we played out. But he's bought at levels of 110. Kush, what's the view on the charts? Should he hold or sell?
No, continue to hold. We've seen PSU banks do rather well in the last 6 to 8 weeks. The uptrend has been rather encouraging, on some of them. Now comes up, at the resistance of 98 to that 100 zone. But I think overall the momentum is good with the banking space. Volumes could have been higher, but we'll take that in volatile times like these. So my suggestion would be continue to hold. Keep your trailing stop, or rather keep your stop losses at the 90 mark. I wouldn't be surprised to see once the 100 level is taken out, the stock move higher to 105 and then 112, which puts it slightly above his buying price, but that would still constitute a view that comes to hold.
All right, so that's the view with regards to where Canara Bank is concerned and where technicals, of course, for Canara Bank is concerned. Our next caller, Brijesh, is calling in from Hyderabad. Brijesh, a very good morning to you. How can we help you?
Very good morning. I have a query. I just wanted to get your inputs.
Sure.
So the query is, I bought Shakti Pump on 820.
Okay.
And I'm holding it, and I'm also a long-term investor, but just wanted to understand your perspective on this stock, how it will go, and yeah.
Okay, got your query, Brijesh. I'll take this up with Shahina. Shahina, Shakti Pumps is the counter. What's the view like?
I believe it's a hold from here. Basically, they have got a huge order book position, and in terms of performance, also they're doing pretty well, and valuations are quite attractive. So to that extent, I would say, given all these factors, it is a hold.
It's a hold on Shakti Pumps. Hopefully that answers your question, Rajesh. And the next question is on Irida. And the stock has been in focus on account of a stellar set of numbers in the fourth quarter. It is, of course, cooling off just a tad bit, 1.5% lower right now. But Divyam wants to know whether this is the right time to buy the stock. Kush, based on the kind of rally that it's seen in the last few days, would you suggest that you wait a little bit, or is this the right moment to add?
Alex, it'll be a good idea to wait a little bit because we've seen a very sharp up move in the last 5 sessions from 140 all the way up until 180, but not sustaining at those levels. Also, we've had a couple of gaps, going along the way where the stock had a gap up opening. You're seeing some signs of profit booking, and that is par for the course. My suggestion would be closer to the 165, 168 zone is where the stock becomes a little more attractive. And once again the levels of 180 and 195 come into play as your targets, with your stop loss coming in close to the 150 mark. So anywhere close to the 165, 168 zone is where you should consider a buy on Irida. So it's a buy on.
Okay, so that's the view with regards to where Irida is concerned. Our next question is from Satyan. He's thanking you, Shaina, for picking up Vadilal a couple of years ago. So he's bought Vadilal at the price of 2,200 on the basis of your suggestion and sitting on a significant profits of around 5.8 lakh rupees. He wants to know as to what should be the next course of action now that he's sitting on a significant amount of profit. Should he book profits, continue to hold, book partial profits? What should he do?
Well, the story is just starting to unfold. At the same time, given the sharp run up in the price, it is starting to get slightly fairly priced. So, to that extent, I would say you continue to hold. They are entering into a number of new spaces. That is the reason why I had actually recommended it, of course, at much lower levels. But now it is doubled from those levels in the last 1 year. I would still say hold, but hold with a stop loss. Keep something like 5,000 rupees, a stop loss, where, of course, I think the investor would still be making money. So keep a stop loss and continue to hold.
Okay, yeah, indeed. He points out, Shaina, very clearly that he's held only because of the conviction that you had in the stock in your recommendation, because he's had a lot of people telling him to book profits at levels of 4,000, levels of 5,000. So he's continued to hold based on that. All right, let's go to Adani Ports. This is a question coming in from, Sumit. Okay, Sumit is asking about Adani Ports. He's bought at levels of 1,200. 400 shares is what he's got. So he's sitting in the green right now, just about, because the stock has made a comeback off late and it's gained quite considerably in the recent past. On the charts though, would you hold for a period of 30 days, and what is the kind of upside? By the way, you have one brokerage that came out today. Was it Morgan Stanley?
For
Adani Ports?
Adani
okay,
Ports,
we'll pull that up, but I
we'll
think
pull
there was
that
an
up.
upgrade in the stock and the target price was raised as well. But on the charts, Kush, what's the view on Adani Ports?
Not bad at all, Alex. It's a good idea to continue holding on to this one. And the 1200 level was, a stiff resistance for the last month and a half, where the stock has actually attempted at least 5 to 6 times and then, given way. This time around, on the back of very good volumes, the stock has surpassed, that level. And when you see, such kind of a breakout, it usually, tends to continue for higher levels. So my suggestion would be hold on the upside. You're looking at targets of 1265, 1300 is a 200-day moving average. So that is also in play right now. So for a period of 30 days, maybe slightly longer, you should continue to hold. The stop loss for this one is at 1180, where the 20-day moving average is.
Okay. Standard disclaimer, of course, the Adani Ports company is part of the Adani Group, and so is NDTV Profit, which, as you know, is part of the NDTV Group.
And you do have a good memory. It was Morgan Stanley on Adani Ports, and they've maintained overweight and hiked the target price to 1418. So that's the view with regards to Adani Ports. Our next caller, Murli, is calling in from Bengaluru. Murli, a very good morning to you. How can we help you?
Very good morning to you. Thank you for taking up my query. I am holding East India Hotels.
Okay.
EIS at an 1,500 shares bought about 9 months ago.
Okay.
At an average price of 425.12.
Okay.
I am willing to wait for more than a year, because considering the upcycle in the hotel industry.
Correct.
And number 2 is ROE, P is the highest in the industry, and P is the lowest compared to its peers.
Right.
So I thought I should hold. What is your advice?
Okay.
Hold, exit.
Okay, got your question, Murli. Yeah, I'll take this up with Shaina. Shaina, in the past few days as well, hospitality, there have been a lot of brokerage notes also coming out, and they are now turning positive in terms of where the entire travel and tourism space is concerned. But there are a few names that are standing out in those notes, and one of them is ITC Hotels, one of them is also Indian Hotels. Murli is holding East India Hotels, that is EIH. What's your view with regards to that? Should he continue to hold that or switch to something else in the tourism space?
He can continue to hold if he would like to, because here the growth is quite good. They have shown a 16% increase in their ARRs, average room revenues. And also in terms of valuation, as he pointed out, it is attractively priced. So he could continue to hold. In fact, if you would like to diversify, I personally also hold, and I think there is good potential even in ITC hotels if you're looking at a medium to longer term view. So you could add that also to your portfolio.
Let me just take a chance. Murli, hopefully that answers your question. But Kush, do you at all track silver and look at the technical levels on silver?
Not on a very consistent basis, Alex, but usually, do keep an eye on it. But yeah, as I said, not on a very consistent basis.
Okay, so while I take the next question, and let me just take a question to Shaina in the meanwhile. Maybe if you can look at the charts, because we've got a view on YouTube we've got Ajay who's asking for a view on silver because he wants to buy ETF. And I know that we normally take stock specific questions, but then commodities also in focus as of now, and precious metals in particular. So I'm going to try and get a view from you, Kush, if you can facilitate. But on Waaree Renewables, this is a question from Afreen who's writing in from Hyderabad. And Shaina, this one's for you. She's looking for a short for a long-term view. Of course, the results came through yesterday, and it's a considerable upside that was reported on the profit, over 80% gain on the PAT number, and the stock is reacting positively to that. If I remember correctly, it was on account of the share of EPC business, which has gone up quite considerably. And so, though you have a narrowing of the profit margin, you have a sizable increase in the PAT number that has come through. So, would you hold on to this, and what are the prospects going forward?
If I would prefer, switching over to Waaree Energies rather than Waaree Renewables, because here it's a recent listing. The valuations are extremely expensive, and to a large extent they are dependent on Waaree Energies, which actually has got a base in the US. So if I was looking to invest in the same group, similar products, I would prefer Waaree Energies over Waaree Renewables.
For Waaree,
so I would say a switch.
Waaree Energy. Shaina, have you looked at any corporate action? I don't know if I'm remembering correctly, but Waaree Energy, is any corporate action that you've spotted? I'll check.
Yeah, you check that.
I'll check. Okay, in the meanwhile, let's go back to Kush. Kush, any view on silver?
So, Alex, very sharp run over the last 8 to 10 sessions on the back of good volumes, but now I see some negative divergences popping up, and also on the hourly charts, the negative divergences are quite pronounced. So my suggestion would be perhaps there could be a correction going forward, a buy on decline kind of a setup to begin with. 94,000, 94,200 is where I think some correction could happen, and that's a good entry point. This rally continuing on the way up, it could very well move to 98,000 and about 99,000 odd levels. So silver at the moment could be a buy on dips kind of setup. 94,000, maybe stretch it a little to 94,200. Those are the levels where I would prefer to enter. If you have an existing position, not a bad idea to continue holding on to this one, but the 94,000 becomes your trailing stop loss.
Okay, all right. Do bear in mind though, Ajay, on silver, of course, you can't lump it in with gold. And gold, of course, has been trading higher every other day, and we're at life highs here in India as well. But silver, a large portion of its price is determined by industrial demand. So if you're talking about 2/3 of the value of silver is attributed to industrial demand, as a result of which, if global growth is going to slow, then you can anticipate that that's going to have downward pressure on silver prices as well, which is why metal counters overall have been under a little bit of pressure in the recent past. By the way, let's address the markets because they are at the day's high. The run-up that you saw at 1:30 p.m. or thereabouts yesterday seemingly is playing through right now. Well, let's see if that gets built up through the day, and pull up the intraday chart for the Nifty Bank as well and see where it's challenging those higher levels. It is in fact doing just that. 0.6% for the Nifty Bank. Any calls here, Kush, on the Nifty Bank? Would you take the opportunity if you've gotten in maybe 3-4 sessions back and you've seen a 3,000 plus point rally on the Nifty Bank? Would you book out right now?
Absolutely, Alex. Yesterday in the closing show, this is exactly what we discussed. That the momentum is for sure there with the financials and particularly Nifty Bank, but it's hit over heated territories on the momentum indicators. While PCR, there is still some comfort. I think the last I checked, PCR was at 1.15 thereabout. So 1.3, there is still some room, but it's hit overheated territories on at least the momentum indicators on short-term charts. My suggestion would be take some money off the table. You might, if you don't want to completely exit, at least book partially, about 50, perhaps 75% of your position. Should be booked out at the current juncture. Look at a buy on decline kind of a setup where a drop till 51,800, 52,000 levels should be taken as a opportunity to re-enter. But yes, at the current juncture, from a near-term perspective, it's definitely a bit overheated. So not a bad idea to take some money off the table.
All right, not a bad idea to take some money off the table is the view coming in where charts are concerned right now. All right, our next caller, Mansingh, is calling in from Andhra Pradesh. Mansingh, a very good morning to you. How can we help you?
Yes, madam. I'm holding arts and chemical shares, madam.
Okay.
110 shares, average price 583, madam.
Okay.
My query is, should I continue to hold the stock?
Okay, and you
Or
bought
should
this?
I accumulate more? Madam, one more, madam. Just listen
sure.
to me, madam. I am also holding.
Okay, so Mansingh, we'll take only one question per viewer. So you will have to choose between Arkin and whichever is the next counter.
Deepak Nitrite and Archean Chemicals. I am choosing Archean Chemicals, madam.
Okay, Arkin Chemicals. Okay, I'll take this up with Shaina. Shaina, what's the view with regards to where Arkin Chemicals is concerned? Should he continue to hold the 110 shares that he's holding, accumulate more, or book profits?
He can continue to hold. Here, 1 year forward valuations are quite attractive. It's about 12 times FY27 earnings, and they are having a big factory that they're putting up. It's in some zinc gel batteries. So I think there also the opportunity is quite big. So he can continue to hold. And in terms of, as I said, valuations is not expensive. It's a small cap company with market cap just about 7,700 crores, but it looks decent to hold as of now.
Okay, all right. Decent as of now is a view on Archean Chemicals. Schneider is the next counter that we're talking about, and Bhupendra has got the next question. He's bought 345 shares at a price of 775 or thereabouts. Should he hold or sell or buy more? He's a long-term investor, he points out. I guess the question is based on the current market price, so therefore let me go to you, Kush, on the charts. He's sitting on a sizable loss because of the kind of erosion in value that you've seen in Schneider. Should he add more the current price?
Advice, so Alex. However, if you see, the stock has actually taken good support near the 600 595 zone. There is a positive divergence popping up on the weekly setup, suggesting that the near-term bottom perhaps could be in place, and the stock might attempt a move higher to the levels of 650 and then perhaps 680 as well in the coming week. However, given the medium-term trend, which is squarely negative on Schneider, I would suggest a stop loss near the recent lows of 575, 560. This is the stop loss around that zone. If that is broken, the stock could actually go into a further TC on the way down. But as of now, it's a hold with a stop loss around the 575 mark. And things getting steady, the stock could actually gradually inch higher, and he could exit at a lesser loss.
Coming back to you, Kush, very quickly, just a clarification. You spoke about Adani Ports and you've given your call. If I remember correctly, you said hold. But would you add the current price? And we've got Alexis who wants to know, should he buy right now?
Well, he can. There's a good breakout, as I said, above the 1200 mark. Even if you take 1300, 200 day moving average as your target, the risk reward ratio is still favorable, better than 1:1. So, you could still at 1200 just lower your stop loss, and 1300 is your target.
Okay, so that's the view with regards to Adani Ports. Our next question is from Angad, who's writing in from Indore. He wants to know whether this is the right time to enter Avanti Feeds. Shaina, we saw a significant amount of downtick in this counter when tariffs were announced, and a slight recovery post the 90-day tariff pause, because they are shrimp exporters, and a large portion, in fact, of their revenue comes from the US. Do you think that this is the right time to enter something like an Avanti Feeds, considering the volatility in Trump tariffs that we've seen?
See, the Trump tariffs are likely to again hit us next couple of months down the line. It's just a pause. So I think it's extremely risky. I would avoid.
Avoid is a view on Avanti Feeds. The next company that we're talking about is Aster DM, and we've got Deepika Ramesh Kumar, who's writing it on YouTube and asking about this. She's bought at levels of 512. Quantity is 320, and the loss is about 5,000 is what she points out. It's not a very significant deviation from the current market price. Kush, on the charts, would you hold on to this one?
Absolutely, Alex. The entire healthcare space, and by that I mean, the hospitals per se, are actually doing rather well. So, while pharma is a bit of a no-no right now, or maybe being extremely selective, I think this space is doing very well. The rebound on the stock also has been very, very sharp and very smart. There could be a possibility that stock might consolidate here for some time, given that it's coming up, at a 510, 525 supply zone. But past that, the stock could actually inch higher to 555 and 575 levels also. So yes, very clearly the view at the moment is a hold on this one. I would suggest a stop loss near the 480 mark.
480. All right, we've got the next caller, Siddharth from Andhra Pradesh. Siddharth, we're running out of time, so quickly, can you tell us your question, please?
Sir, Ujjivan Small Finance Bank, sir.
Yeah.
I'm holding 4,000 shares, average price 40 rupees, sir.
Okay. What is your time frame?
Should I book profit or 2 to 3 years, sir?
2 to 3 years, right?
Yes,
Okay.
sir. Yes, sir.
Okay. Shaina, on the fundamentals, 2 to 3 years, bought at levels of 40. He's in the green. Should he hold?
He can hold for now, and he can look at higher levels to switch. The sector is doing well as of now.
Okay. It is time, in fact, now on the program we're winding down and it's time to hit the rapid fire segment. So Kush and Shahina, this is a heads up for you. We're going to throw as many questions as possible at you over the course of the next 2 minutes. I'm going to start with a question from Prameet. He's asking about Agarwal toughened glass. I'm not sure if anybody has a view on this one. If not, just say no. Shahina, border levels of 133. Any view?
No.
Okay. HDFC Bank, I'm sure Kush is going to have a view on this. 1655 is a buy price. Smart up move in the recent past. Would you hold is a question. Bharat wants to know.
Absolutely. Continue to hold. Keep a shilling stop loss at the 1820 mark.
Okay, Rajkumar from Kolkata is holding Sky Gold at an average price of 4350. Now it is 435 because of the bonus issue. What's the view like, Shaina? Should he continue to hold?
Yeah, he can hold. He can hold with a stop loss close to about 320.
Okay, got it. Suzlon Energy, Shaina, coming back to you on this one. Partha from Kolkata is bought at levels of 67 apiece. Wondering whether hold, add or sell at this juncture.
I would say it's a switch.
Okay.
To what?
Switch to some other, maybe Tata Power.
Okay. Avantel Limited is the next counter. Rakesh from Hyderabad wants to know whether this is the right time to enter the counter or not. Kush, on the charts?
Yes, you can. The stop loss, that's the first one. So the stop loss is at 119. On the upside, you're looking at targets of 135 and about 144. So yes, you can add at the current time.
Okay. Shaina, Sagility India, Vijay wants to know whether to hold. He's bought at an average price of 50 rupees. He's got 4,400 shares. Should he hold?
I would say exit.
Okay. Heritage Foods is the next counter. We don't have the name. So, okay. Suman Kumar from Hyderabad wants to know whether this is the right time to enter or not. Kush, on the charts?
Yes, the stock's given a golden crossover, so you could consider, adding good momentum building up. Stop loss would be 405 and targets 435 and 450.
Okay, NTPC Green, last question. View on 6 months is being sought. Bought at levels of 88 rupees and 1 year, maybe 1 year target. Kush?
Definitely continue to hold. Stop loss at 102 and on the upside targets of 117 and 125.
Okay, all right. On that note, it brings us to the end of this edition of Ask Profit. Kush as well as Shaina, as always, thanks so much for joining in. Always a pleasure and wish you a happy weekend. All right, to everybody tuning in, we tried our best to take as many questions as possible, and hopefully over the course of the last 1 hour, whatever we've taken has benefited you, even if your specific question was not taken. Thanks so much for watching. From Mahima and myself and the team that put the show together, thank you so much. Do stay tuned. This is NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Hello and welcome to KYC, Know Your Company, a show designed to give the regular investor powerful actionable insights into the fundamentals of a single listed company every day. And today we're going to talk about Federal Bank. It's in focus because there has been a reasonable amount of rejig, both on the leadership front, with Shalini Warrior, who was a key part of the leadership now choosing to step down. And you have KVS Manian, who was ex-Kotak Bank, who took charge in September of 2024, and now it's been 2 quarters since the time he's fully taken charge. What we're going to do is, of course, we're going to break down Federal Bank for you, and thereafter we're going to speak with an analyst to try and understand whether the commentary emanating from the company is reasonable in terms of expectations and whether it's achievable. We thought this is the better path to take. Because it'll give us better perspective. There's enough commentary to talk about. So let's get right to it. What about Federal Bank? It's one of the oldest private sector banks in the country. 1931 was when it was incorporated. It was predominantly south-based, continues to be, operates through around 1500 odd branches. The focus largely is South India. That's where it gets a bulk of its market share from. The market share, it's one of the top 3 banks, both in terms of loans as well as deposits,
in South India. So significant presence in that sense. We had KVS Manian, who now leads the bank. I did speak about that. September of 2024 is when he took over. Why is this important? Is because he is driving a huge change within Federal Bank. One, he's played a key role in Kotak Bank earlier, and a key role in their transformation from NBFC to bank. He's expanded retail banking at Kotak. He's also led corporate and investment banking at Kotak. So those sides of the business he has deep experience in, and therefore will be important to understand what he is trying to do at Federal, which I will come to, and thereafter we'll speak about execution, whether it's even possible or not. Now, in terms of how the loan mix is, corporate and commercial is around 1.02 lakh crores, around 1 lakh crore book, corporate and commercial. And then you have retail, which is a larger chunk. So 55% of the book is retail, around 45% is corporate. That's how the split is. The growth, as you can see, in retail is healthy and in commercial is healthy. Corporate is slightly sluggish. This is at least over the last year or so, and therefore these figures will give us a reasonable angle on what the company has done over the last 12 months or thereabouts. Within retail, where's the focus? Well, one is pure play retail, then there's specific loans, something like a gold, something like a business banking loan. So some of those aspects also come in, but this is more from a perspective to help you understand what are the segments that it currently caters to. If we look at the next graphic as well, we'll add, there you go, agri-allied CV, but very small, right? In CV, just 3,000 crore book, and MFI, just about 4,500 crore book, and then you have MFI, which is around 4,000 crore in terms of book size. The growth there is obviously faster because it's off a low base, and therefore something that we'll have to keep in mind to see how the strategy will evolve going forward as well. But that's how the bank has shaped itself up, at least over the last year and historically. More south facing, and this is how it's split in terms of segments. Now let's talk about the factors that we look at. We'll first start off by looking at the income statement. Thereafter we look at the balance sheet. We look at operational metrics because those are important, and we look at asset quality as to how that has evolved, and we'll rate each of these parameters. We look at shareholding, valuations, the street coverage, and the street credentials. We'll look at all of that, and thereafter give a comprehensive assessment on what this looks like. Let's first start off with the income statement, and mind you, it's a relatively small bank in that sense, and therefore you would expect it to grow faster than mid-teens, but that's what it's done over the last 3 years. In an era where growth has been extremely strong, we've seen just about a 14.5% growth on the net interest income number. Operating profits even more tepid at just about 11%. What's really aided profitability is the fact that you've seen a sharp rise in your, a sharp fall in your provisions number, which is aided profitability. The other piece also to know is FY23 was a relatively better year than FY24, because FY24, or rather FY23-24, have largely been better than even an FY25, because FY25 we've seen sharp margin compression, and we'll talk about that in the operational metrics, and that will also somewhere reflect in profitability. So NII may be slightly compressed in that sense, but yet a 14.5% growth on the NII account leaves something on the table to be desired, and therefore we'll give this a neutral. We'll also look at the balance sheet. When we're looking at the balance sheet, again, you'll look at the growth on the advances, gross advances front, it's just about 16.5%. So again, in an era where at least the last year or two, maybe the last year has been sluggish in terms of loan growth, but prior to that, for a year or two, there was extremely healthy loan growth in the system. So you would expect a bank size of Federal to probably go slightly faster than a 16.5%, and deposits have been even more tepid. It's at 13.5% on the deposit growth front. Look at the CASA, and the CASA ratio is even more difficult in that sense. The CASA ratio is just about 30% currently. So overall, we'll give this a neutral as well on the balance sheet count. Not the best when it comes to the growth that's coming through in the system versus what a medium-sized bank ought to grow at. Let's last off look at one metric, in that sense, is the operational metric that we look at. And within operational, you look at how yield on advances have crept up. Not surprising per se, but it's definitely a healthy inch up in terms of yield on advances. If we look at the annual yield on advances, it's moved up from 7.8% in FY22 to 9.2% in FY24. This is also on the back of the fact that you would have seen an inch up in the repo rate from FY22 to FY24. Mind you, April, May of 2022 was when the repo rate started to get hiked, and therefore some of that also spilling over on the yields. But you compare that to a cost of deposits, it's gone up from 4.1% in FY22 to around 5.5% in FY24. And when you're looking at the cost of deposits even now, you'll see the deposit cost inching up from 5.84% in Q1. It's gone to 5.92% in Q3. So just in a few quarters, you're continuing to see that pressure with regard to cost of deposits, and that is keeping a lid on margins. And now this is where it gets interesting. The net interest margin number, which was at 3.2% in FY22, inched up to 3.5% in FY23 because you had the repo rate go up, but deposit rates did not catch up very quickly, and therefore you had a lead lag for about a year. Thereafter, you saw it come back down. You saw it come back down to 3.3% in FY24, the margin number, and thereafter we've seen even more margin pressure, as you can see in FY25, 3.16, 3.12, 3.11. And a lot of that has spilled over to the ROA number. Before I come to the cost to income, I'll talk about ROA. ROA, which was at 0.89% in FY22, inched up to 1.25%, went further up in FY24 to 1.31%. Why? Because of the credit cost number being extremely low. If you remember, in the P&L that we spoke of, the provisioning number was extremely low in FY24. If we have that graphic, let's put it out, because FY22 provisioning was at 1,222 crore, FY23 was at 750 crore, but FY24 was just at 196 crore. And that was the number that actually aided ROA more than anything else. But FY25, you're starting to see an unwind on that particular number as well. And therefore, you're seeing ROAs come off 1.27 in Q1, 1.28 in Q2, but 1.14 in Q3. So you're starting to see an inch down with regard to ROAs. Can those ROAs sustain? Because that will determine profitability for the company. That's something that we have to look out for. So operational metrics, not very impressive. Neutral on the operational metric count as well. Let's look at asset quality. And now this is key for a bank, right? Would you want your asset quality to continue to improve? Yes, for sure. And that is exactly what Federal Bank has done. A clear thumbs up on this metric. From 2.8%, the GNP has come down to 2.1% in FY24. And thereafter, it's further inched downwards. And this is, mind you, in a difficult cycle as well. We are seeing pressure in some pockets in the lending industry, and despite that, Federal Bank is able to hold up fairly well. So that comfort is available. While they're doing lower margin product, they are also being able to control asset quality. So clear thumbs up on that count. In terms of margins as well, among the top 5 private sector banks, Federal Bank trades at a considerable discount in terms of margins. So if it has to chase the top 5 private sector banks, it has to considerably improve its net interest margins. NPA also very similar trajectory carried. Now the net NPA is down to just 0.5% at the end of Q3 FY25. So a clear thumbs up where asset quality is concerned. Let's talk about shareholding, and this is where also it's quite interesting. You look at the FII holding. When I'm looking at it over the years, it's come off, but March of 2022, it was at 26.01%. It continues to remain at around 26.3%. So largely, that's how it's played out. We have an interesting set of investors in the FII basket as well, and I want to quickly talk about that. You have IFC, which is International Financial Corporation, which directly holds 4%, and then has other funds through which it continues to hold maybe another 2 to 2.5%. So IFC Financial Institutions Growth Fund LP and IFC Emerging Asia Fund LP also hold 1% each in the company. So that's a decentish holding by IFC. Outside of that, you have Bank of Muscat India Fund. You have the Government Pension Fund, which used to own and some interesting names, obviously, as part of the old shareholding of Federal Bank, dated. But for the moment, IFC is the key large shareholder. Even among the DII basket, you have an HDFC mutual fund, which holds 7% in Federal Bank. So some good institutions which have a decent holding in the company from an investor perspective. So shareholding neutral overall, no major promoter, but you have these institutions which hold a decent amount of shareholding within the company. That's one. Now, last couple of factors. Let's talk about street cred first. When we're talking about street cred, there you go. That's the last 1 month performance for Federal Bank. It's been a very strong performer when you're looking at it over the last year or so, 27% increase in the stock price over the last year. And we've also seen a decentish kind of return that the company has given over the last 5 years or so. In fact, the 5-year chart indicates it's been a multi-bagger, 322% returns from that 50 rupee mark, or rather it slipped even below 50. It was at 40, 45. It's currently sitting very, very pretty at 195. So it's made good returns for investors in that sense, and therefore street cred has been rated as a thumbs up from our side. Let's look at valuations. This is again crucial because you have to look at valuations even from a perspective of how what's the kind of strategy that's been implemented. I'm going to quickly touch upon that. There's been a leadership change and there's been a strategy change. There's the leadership and strategy change now entails an improvement in margins. How are they going to do that? CASA ratio is going to go from 30% to 36%. They're going to improve on their CA composition from 6% to 10%. They're going to tap non-resident customers and non-South based customers. Those are two pockets of customers which they are doing well with. They're going to go outside that and tap those. Branches is going to be the way they're going to do it. 1,550 branches currently. They're going to hike it to 2,126 branches in the near term. They're also looking at, therefore, pushing higher deposits. Higher yielding assets is what they're going to do. Larger focus is going to be on vehicle loans, tractor finance, affordable housing. There's going to be an increase of fee income through Forex, wealth management income and credit cards. And your cost to income is eventually going to come down from 50+% to 41%. That is what is going to lead to a target ROA of 2.2%. They're going to bring down cost of deposits. They're going to inch up yield on advances. They're going to increase fee income, and they're going to do cost control on the top line. All of those should hopefully aid the ROA number. And therefore, it's currently placed in terms of valuations at 1.3 times, right in the middle versus some of the other mid to small banks. Slightly at a discount, or rather at a large discount to some of the larger private sector banks, and fairly so. If Federal Bank has to make that journey, it has to do a lot of execution, and if it does that, then likely it will command a premium in terms of valuations, and fairly so. And therefore, we'll give this a neutral because we want to see more execution, and whether this is realistic in terms of guidance or not, we'll obviously have an analyst, Rahul Malani, who will come shortly and speak to us about that. Last off is street coverage. Let's talk about that. 39 buy calls, 3 hold calls, 1 sell call. That's broadly how it stacks up. 14% upside. We'll give this a thumbs up. Very well covered and a decentish upside as well. 12-month returns. Now let's talk about all the rating parameters that we've just spoken about. Let's stack it up. There you go. So you've got income statement, balance sheet, operational metrics, and asset quality has a thumbs up. And then you have shareholding, street cred, valuation picture, and street coverage, and that gives us a 5.5 on 8 on our KYC ratings. So that's how it stacks up for a federal bank. Now let's go straight across. We have Rahul Malani, Senior Research Analyst at Mirae Asset Sharekhan, who's here to talk to us about exactly this. Rahul, huge transformation that's expected from federal bank. First off, I want to understand from you, how are you looking at the overall strategy? And let me ask you a blanket question on what you believe the execution risks are to this strategy.
Yeah, good morning, first of all.
Good morning.
So, if we look at the compare the federal bank with some of the private frontline banks, operational performance has been a laggard for the federal bank. After the leadership change, the bank has outlined its revised strategy with coming out with improvement in the levers, improvement in the asset mix as well as the liability mix, where the focus is to improve the NIMs and the fee income part, which will really drive the operational performance in line with comparison with the other frontline private players. So it's a tall task. Execution is key, as you outlinedly mentioned, because 70 to 8, the bank is guiding for 70 to 80 basis points improvement in the ROA over the next 3 to 4 years. So we believe that at least 30 to 40 basis points is achievable, but 70 to 80 basis points is a tall task. While in terms of performance over the next 2 years, we believe that for the strong re-rating in the stock, there is a need to improve the risk-adjusted returns that should be comparable with the front-end private banks. So outline strategies in line with improving the risk-adjusted returns, taking into comparable to the private banks. But it will be a tall task over the period. But we acknowledge that we have to watch out from quarter to quarter where the execution is happening on the ground. And as and when the operating metrics starts to improve gradually over the period, there would be certain partial re-rating over the next 2 years in this period. In terms of valuations are reasonable for federal bank. But overall execution is at this point of time is key. And at this point of time, we will like to give a positive probability to execution, because after the leadership change, almost we have a veteran from the banking sector who has almost experience of more than 3 decades working in the Kotak Bank. So we will like to assign a positive probability towards execution, and we will ramp up we will look at quarter to quarter improvement in the operating metrics as and when it starts to report in the performance.
Point taken. Rahul, one key concern at this point is with regard to margins. They had spoken 4 quarters ago under erstwhile leadership that margins will not fall below 3.2%. It thereafter fell at 3.19. They said a few basis points here or there. Now it's fallen at 3.11%. The margin pressure seems to continue. Now you have a repo rate cut as well, which has come through, which should further accentuate the problem. How should one look at margins for Federal Bank? And is that at all a concern for you from an analyst perspective? What are you building in terms of the margin number for FY26?
See, clearly in FY26, there will be a margin compression of around 20 to 25 basis points if there is a 100 basis points cut in the calendar year overall for the Federal Bank. So clearly there will be a margin compression because 50 to 60% book is linked to the external benchmark rate, and then repricing. If you look at in the last higher interest rate cycle, when the rate starts, when the RBI started to increase the rate from May 2022, we had seen a sharp increase in the yields for Federal Bank, because they are more sort of their higher share of book is linked to the external benchmark rate, and then they are the revision time period is relatively smaller for the Federal Bank. So clearly, in terms of in this quarter also, quarter four also, you will see much higher compression in the NIM for Federal Bank. Over the medium term, as I alluded that when company is speaking about improving the liability mix, like in the form of improving the CASA share from 30% to keeping it, taking it to 35-36% levels, and then start focusing on mid-yielding assets. Like for example, they will now focus on the used CVs, used vehicles, lab, tractor financing, micro lab loans. So which they are earlier didn't do, which have certain partially higher yield, but in terms of risk also, the risk is manageable other than with the unsecured book stands. So risk is lower than the unsecured book, but partially higher in yields. So overall, overall over the medium term, at least from the at least 2 to 3 quarters after that, we should see if that execution is happening on the liabilities or the asset mix, and then we can decide upon the same.
Point taken, but 25 basis points is a large decrease to the already established floor that they had guided for. So you'll see margins fall below the 3% mark. And how realistic is this increasing of CASA from 30 to 36%? Are we building in too many risks into this, Rahul? Because you have an ROA problem then. You would likely say that ROA in the mid to near term has peaked, right?
Yeah, your conclusion is right that ROA has peaked in the near term, at least for the FY26 versus compared to the FY25. But I have spoken of 20 to 25 basis points over the period of cycle. That is for the when I am taking into account 100 basis points compression, 100 basis point cut in the repo rate cut. So overall, in this quarter, we should see 5 to 10 basis points compression in the margin for Federal Bank. And at this point of time, there is no lever because they are into their investment phase. OpEx would be elevated. Credit cost is already at the rock bottom, around 30 to 35 to 45 basis points of credit cost will be there. So there are no certain lever to offset that compression in terms of ROA. So
correct.
Basically,
yes, Rahul, complete your point, please.
So basically, I don't find any levers to counter that NIMS compression. So yeah, there will be a ROA compression led by NIMS compression in the near term, in the at least coming quarters.
Point taken. Faster growth, Rahul, is what Federal Bank offers. But when I'm comparing valuations of a Federal Bank with some of the PSU banks looking better, all on margins, even maybe a bit more comfort with regard to ROA metrics. You also, so because you don't have ROAs peaking or rather peaked in the past and now falling trend line on ROA, that's not reflective, right, on some of the PSU banks. More comfort, more safety. So is Federal Bank therefore a decent bet at this hour, given that you have 1.3 times price to book is what the stock is trading at, and you have so many risks which are yet to play out?
Basically, in the near term, we believe that the valuations are full for the Federal Bank.
Okay.
But over the medium term, as I alluded that at least if there is certain improvement in the asset mix as well as the liability mix, NIMS improvement will be there in the franchise, which will lead to higher operating profits. So which can lead to improvement in the ROAs. From that perspective, if we take a bet for at least 2 years, then we may see that the Federal Bank appears to be a reasonable bet for at least for the medium term perspective. But as you alluded, in the near term also, basically all the mid-sized private banks would see higher compression because of the weak liability mix, weak liability franchise compared with the large private banks or PSU banks per se compared.
Point taken. Thank you so much, Rahul. Rahul, one quick question. If margins were to compress by 25 bips, what will the ROA therefore compress by? And of course, credit costs start to normalize.
We don't see ROA falling below 1% for Federal Bank.
Okay. Point taken. Okay. Thank you so much, Rahul, for coming and giving us that perspective. And completely out of time on this edition of KYC on that note. Hope you found this helpful, hope you found this insightful, but completely out of time from myself, everyone who puts the show together. Thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
Role, responsibilities of board, its committees. Now, disclosures are periodic and event-based. To ensure transparency and information symmetry in the market, SEBI has specified periodic disclosures of certain information, such as quarterly disclosure of shareholding pattern, compliance with corporate governance requirements, financial results, and deviation in utilization of funds. To prevent information asymmetry, there are also event-based disclosures of material events of information, such as disclosure of material events within the specified timeline, disclosure of events which may have material impact on the performance or operations of the listed entity. Such disclosures ensure that the stakeholders have equal access to material facts and information related to companies' operations and performance. This promotes level playing field by bridging the gap between company insiders versus outsiders and the better decision making by the investors. So some regulatory measures, instances of false, inadequate, inaccurate, misleading and delayed disclosures of material information by listed entities leads to information asymmetry in the market. In order to bring more transparency and to ensure timely disclosure of material events and to facilitate a uniform approach in determining materiality of events of information, and after consultation with stakeholders, we have amended the LODR regulations to introduce quantitative threshold for determining materiality of events and information. Similarly, guidelines have been made on timelines for disclosure of material events of information. To address the issue of perpetuity of special rights and to do away with practice of permanent board seats, we have brought in periodic shareholders approval, which is once in 5 years, for any special right granted to a shareholder of a listed entity, and also periodic shareholders approval every 5 years for any director serving on the board of a listed entity. To strengthen the independence of independent directors and enhance their effectiveness in the protection of interests of minority shareholders, SEBI has mandated that at least 2/3 of the members of the audit committee must be independent directors. Now, the ease of doing business is important, and there have been some initiatives recently. To promote ease of doing business, SEBI has introduced single filing system for listed entities. Tech-enabled single filing system now eliminates the requirement of filing the same documents across multiple exchanges. With the advent of technology, there is substantially reduced reliance on newspapers for getting information on financial results. Thus, to reduce the compliance burden, SEBI has made it optional for listed entities to publish detailed newspaper advertisement with regard to disclosure of financial results in newspapers. Further, to promote ease of doing business, timelines for disclosure of outcome of meeting of the board of directors that concluded after trading hours has been increased to 3 hours from earlier 30 minutes. Similarly, the timeline for disclosure of litigations or disputes involving claims against a listed entity has been increased to 72 hours from 24 hours earlier, subject to maintaining such information in structured digital database. And recently we have provided flexibility for companies by allowing either assessment or assurance of BRSR core disclosures. This reduces compliance burden while ensuring credibility of data reported under BRSR core. ESG disclosures for value chain are now voluntary and applicable from FY 25-26. But is that enough? So what's the way forward? As a regulator, SEBI has laid down a comprehensive governance framework on the corporate governance. We have taken measures to protect the interests of investors, at the same time tried to facilitate ease of doing business. But to achieve the desired objectives, we need to have a collaborative ecosystem. There needs to be a balance between regulation and ease of doing business. We are conscious that over-regulation can stifle growth and innovation. At the same time, too little regulations can also lead to decline in trust of stakeholders and adversely impact growth. Thus, there is a need for optimum regulation. Regulations need to be rationalized by removing what is no longer relevant and reducing overlaps. Stable and adequate financial regulation can help in creating a high-trust environment, increase attractiveness for investors, and promote economic growth. What we can do about effective self-regulation by entities? We need to move from a thinking of minimum compliance to maximum governance. Boards must rise above routine and ask difficult questions, and auditors and independent directors must act as gatekeepers of integrity. Our regulations, which are LODR, lays down the principles which outline the essence of expectations of SEBI from the boards. There is an emphasis on doing the right thing for the right reasons, asking the right questions, constructively challenging management, demonstrating sound judgment, possessing an independent perspective, and avoiding groupthink. Corporate governance is not a matter of regulation alone. It's a matter of conscience. SEBI will continue to expect higher bar on governance, but true and lasting change must come from within the corporate boardrooms and cultures. And Mr. Bajaj was actually mentioning, he was giving a glimpse of what they are doing about their own organization cultures. And there are several good practices, and those need to be carried forward, those need to be propagated. There is a need for industry to adopt RegTech solutions, which is use of technology-based solutions for complying with regulatory obligations that can help in improving compliance reporting, streamlining processes, and improving the operational efficiency. SEBI and first-line regulators, which is exchanges, are deploying SupTech solutions for effective and enhanced supervision. The use of technology by regulators has been very helpful in detecting early signs of market abuse and non-compliances. Harnessing technological advancements could further reduce the potential blind spots, market misconduct, and instill a culture of continuous compliance amongst regulated entities. The governance is not about ticking boxes. It's about building institutions that can be trusted for years and decades. It's not an easy path, as it involves sacrificing some short-term gains. But it is the only path to have a sustainable growth and development of a corporate.
IDFC First Bank's board has approved a fundraise of up to 7,500 crore rupees from two of its investors. We spoke to V. Vaidyanathan, MD and CEO, about the fundraise and next stage of growth for the bank.
we felt that the bank will need capital for the next phase of growth, because the phase one is what, let me say, was a setup stage. Still setup stage, but next phase we can move over to profitability in a very meaningful way, and we need capital. From that point of view, frankly, I spoke to maybe one or two more people also, but these people, I know them for like 10, 12 years now. I have confidence in them. They are like wonderful people. And RDA, of course, is a iconic institution.
Mr. Vaidyanathan, Sajit here. In the last 3 years, we have raised almost 14,000 crores. It's a huge dilution which is coming on your equity as we speak. And at every time you have raised funds, if I can take some of the numbers, 95 rupees you raised 3,000, last year at 80.63 you raised 3,200, and now at 60 you're raising 7,500. 14,000 odd crores and at a declining price. The shareholders will be a little worried, saying that you're diluting very fast and at a price which is lower than the last raise.
No, before that also we raised two.
I'm talking about just last 3 years alone.
I know. I'm saying over and above that, prior to that, we raised at 57 also. We raised at a lower price than that also. We raised at multiple prices. But the good news, Sajid, is that all of these raises have all been above book value per share. All. So every one of them adds to book value per share, because you're giving new shares at a higher price than the book value. So net, the book value per share after this transaction will touch close to 53. But that's one point. That's one part of the story. Now, I think a more fundamental question should be that why you're raising capital, so much capital, why you're raising so frequent capital? Is that the question simply?
Yeah.
Now, I need people to understand this basic fact that if you look for a bank which is like 30 years, 35 years in existence, they're already running to peak profitability. So their capital is almost equal to the return on equity. The growth is almost equal to return on equity. They can keep on forever. But for our bank, starting from zero. So for a bank which has a zero return on equity to start with in 2018 or 19. So, right now, let me call it around maybe 7-ish or so, if you take out MFI impact. So your return on equity is 7, growth is 20, the gap has to come from capital. But the good news is that 0 has moved to 7. We believe 7 will come to 15 or 16 also. But it's a phase. Early stage bank, every bank starts low and then becomes, bank like ICICI or HDFC. Think about how ICICI raised capital 20 years ago. They raised $5 billion in 2005, $3 billion, something like that in 2005. That's one of the capital initial stage people raise.
The capital raised by those banks has not been on a yearly basis and at a price which is, declining in that sense, right? So that's the worry.
That's not a fair question. If you go back and see, say, ICICI Bank, etc., 2005, 2007. So imagine that time, like 2007, to raise $5 billion. I'm not referring to ICICI Bank, another bank. The point I'm trying to tell you is that early stage bank needs capital, short answer. You just need capital because return on equity is lesser than growth of the bank. But the good news is, like I told you, it's coming at a premium to the book.
Mr. Vaidyanathan, just a quick question around the OPEX side of the story, because that is one complaint that a lot of analysts have been pointing out, that the bank, yes, over the course of this financial, FY25 at least, you've seen that OPEX trend down, at least the OPEX growth trend down. It is still higher, of course, but the rate might be slowing down. I want to get a view, is this also one of the reasons why you would need a more capital infusion?
I think Vishnu, you're connecting some...
Sure.
Something else to something else now.
Sure.
End of the day, your return on equity is lesser than the growth of the bank. That's it. Now, whether as far as OPEX is concerned, it is coming down. This quarter's results yet to come out. So don't take me in a direction where I have to reveal this quarter's results.
Yes,
please,
of course.
I can't go there. That is not the agenda of this discussion. We are talking about capital raise in this context, but this is nothing as simple as saying that return on equity is less than the growth of the bank. But the good news is, let's focus on why do such seasoned high quality investors want to invest 7,500 crores? Let's be clear about that. So there is some reason, right? And I believe that if they are going to make money in this transaction, I hope they do, then everybody makes money.
Okay, just one point of addition. So the investor presentation that you released to the exchanges, that points out that one of the goals is, of course, to fund the next phase of growth, as you have already said in this interview as well. One line caught my eye, 20% over the next few years. What is giving that confidence? Because not very long ago, there was a lot of caution in the Indian banking system.
No, if you see our bank, the first 3 years we did not grow the loan book. First 3 years. 2019 we merged, FY19, 20, 21, 22 we did not grow. There's a reason, because we had a very high credit deposit ratio and a very high credit, like 169% credit deposit ratio, including corporate bond issuances, and we thought that 136%. So if that's high credit deposit, we could not give any more credit. We did not want to give, and we grew deposits the first 3 years. But that phase is over now. Now our credit deposit ratio is incremental lending only 75. We can afford to lend. So now we're in the growth phase. So I feel that 20 is not like a big deal for a bank which has so many capabilities. Main thing is asset quality. If asset quality is good, you can grow. And our asset quality, gross NPA is less than 2, net NPA is less than like 0.6 or 0.5. And the credit cost is so much under control, except the MFI problem, which we'll talk separately. So if the bank is good, growth opportunity is there, asset quality is good, you can grow.
Mr. Vaidyanathan, while you mentioned that for the next few years you would be looking at a growth of 20%, the capital raise which you have done of 7,500 crores, are we to assume that for the next few years you will not be coming back to the market for capital raise because this capital is enough for that growth for over the next 2 to 3 years or so?
I think so, because after all, this is a large raise. One of the purposes of taking a large raise, to your earlier question, Sanjeev, that we were talking about, every year the bank is raising capital. I don't deny. But do you think I have a choice? Do you think anybody had a choice? It's a startup bank and it has to grow to reach a particular level of return on equity. Till that time, it has raised capital. So for 3-4 years, we have in 5 years, we raised 5 rounds of capital in 5 years. But good news is that people are giving us capital. We have made ourselves attractive for investors enough for fresh people to look at the bank, see the model, see the economics, see the culture, see the tech, see the growth, see the deposit growth. So people are seeing all this and fresh money is coming into the bank. So I'm really happy that the bank has been made attractive for fresh investors, and 5 years in a row. Now that we raise big capital, they will not come to the market for a foreseeable future.
And when you said that you're looking at improving your return on equity because that's what is the focus, is there a level that of return on equity that you are aiming at, and is there a path to that?
Of course. I'm glad you asked that question. It is the important thing. So when I start a company at 0, you reach 7. Now after 7, you're at 15. So we have to go. There's no question. And any good bank should be posting 15 plus return on equity and should be, but there's no choice. You have to start somewhere. We start from 0. We'll touch 15. It has to go there. But path is like simple. We are already making good money on the lending side. We have good economics. Adjusted for risk also, we're making good money. We are losing money on liabilities because it's a new bank setting up branches on that, and credit cards. Both these businesses, every year they're losing lesser money than last year in a percentage sense, as a percentage of book.
And this 15% that you're targeting, is it next 2 to 3 years? Is that the timeline that you're looking at?
We don't put out very specific year-by-year guidance like that, stuff like that, because we are running a bank and, but directionally we're heading there.
Okay. I want to take one last question, Mr. Vaidyanathan, and that is on.
But if you think of all the even iconic institutions, like the well-known banks of India, every institution starts from 0. That's how every institution starts. So, but good news is bank is catching up very fast. Just to give you an idea of how powerful the machine is, our operating profit have now touched. Last year has touched close to about 6,000 crores. It was less than 1,000 crores. In 2019, it was 750 to be precise.
Yeah, I was looking at the presentation. It said about 6x, I think, between FY18 and now.
Yeah, 8x. 8x is the deposit growth. Deposit growth is 8x.
Got it. Got it. Well, okay, let me ask you one last question, and this is the MFI point, because that's something that's been mentioned a few times in this conversation. I wanted to get a sense. A lot of expectation was that by Q4 you would have seen the end of the problem, and Q1 you would have seen some amount of normalization. Now I know this is pre-result, so you can't really give specific guidance, but are we to expect that before the second quarter you would have most of the system would have gotten over this MFI hangover? Because the reason I'm bringing this up is because some state governments have also taken certain actions which are sort of prejudicial to the broader microfinance segment.
So because results are around the corner, I'll take nothing. So take none of my comments as this quarter's comment. Let's stick to what prior comments.
Yeah.
We have already guided that Q4 will be the highest credit cost because of MFI. It will peak, and we said that Q1, Q2, Q3, Q4 should come down. And these are 2-year loans. Already 1 year has gone by. We stick with what we said. Rest wait for the results to come.
All right, Mr. Bhairavan, thank you so much for taking time out and talking to us, sir. Pleasure talking to you.
Thank you. But on a closing note, I must say, since the agenda of the discussion was more about the capital raise, I want to just say that this is a very momentous occasion.
Yes.
To raise that kind of capital in the global environment the way it is, with all kind of crisis and chaos all over the place, for investors to give this kind of capital to the bank is really, we made the bank an attractive place, and I'm very confident we'll live up to it.
Well, on April 9th, 2025, the Reserve Bank of India's Monetary Policy Committee reduced the repo rate by 25 basis points to 6%, marking the second consecutive cut following a similar reduction in February 2025. And the reason for the cut was primarily to stimulate economic growth amid slowing GDP and global uncertainties, including tariffs, in fact. The MPC also changed their stance from neutral to accommodative, hinting at further rate cuts in the future. But to understand the effects of this on a deeper level, I'm being joined by Shweta Dabtardar, Vice President, BFSI Elara Securities, and my colleague Harsh Sayata will be partaking in this conversation too. Welcome, Shweta. Thank you so much for giving us your time. Let me set the stage for you by asking, yes, a repo rate cut is good from the sense of easing liquidity, but how could this affect the margins of major banks, and who would this impact the most? Shweta? Shweta, can you hear me?
Yeah.
Okay, no issues. Harsh, why don't you give us a sense of what are the implications of a rate cut? Yes, a rate cut is good. And when the RBI's governor was giving his speech, he mentioned that he is cutting these rate cuts to ease liquidity because there's a slowing GDP growth as well. But we've gotten Shweta back. And Shweta, are you with me now?
Yeah.
Okay, amazing, Shweta. Thank you so much. As I was asking you, a repo rate cut is good from the sense of easing liquidity, but how could this affect the margins of major banks, and how would this impact, who would this impact the most?
Okay, clearly having
okay, yeah, no problem.
But okay. So while they fix that, quickly onto your question.
Yeah.
So yes, a repo rate cut would likely has already in fact translated to deposit rate cuts at lots of major banks.
Correct.
We've seen ICICI, Axis, HDFC, and an SBI even come out and say that they've cut the deposit rates. So one is you'll start to see deposit rates come off, and you'll also see loan rates come off. So any external benchmark loan rate should ideally be coming off by 25 to 50 basis points already. MCLR, which is more linked, and that's again another type of linked loan, that may take some amount of time to come off as the cost of funds of various entities start to come down. But the immediate translation will be deposit rates coming off. The other immediate translation will be NBFCs benefiting from a lower cost of funds. Both of those should translate pretty much quickly.
Sorry. Oh, Shweta is back again. Let's try again. Shweta, can you hear me?
Yeah, I can hear you.
Okay. So Shweta, as I was asking you, and this is my third time, I really hope that you get my question now. How do you think the repo rate cut is going to affect the margins of major banks, and who is this going to impact the most?
Yeah, so I'll touch base on NBFCs because that's where my expertise and forte lie. So as far as 50 bips repo rate cut is concerned, it is determined by three factors. So one is fixed versus floating rate loans as far as NBFCs are concerned, then funding mix, and lastly, the way these NBFCs can transmit these rate cuts. So NBFCs factoring in 50 bips repo rate cut, the ones with fixed rate loans, say for instance, Bajaj Finance, SBI Cards, Chola Mandalam, these will see stable yields and lower borrowing cost. So any NBFC with fixed rate loan book will benefit in the near term as far as rate cuts are concerned. And NBFCs with floating rate loan book will have a certain lag and will see certain pressure on net interest margins in the interims. But effectively, a 50 bips rate cut will definitely translate into over 20 to 40 bips kind of cost of fund reduction for NBFCs.
And Shweta, Harsh also joining in. How much of that will translate or get transmitted in your understanding to the consumer? Because that's the other thing which the governor has alluded to.
Yes, so as you rightly mentioned, there has to be transmission that has to happen through yields. And I think we are already sort of getting there with banks already beginning to cut their deposit rates. We are also expecting and hoping it will flow through and transmit through lending rates as well. But we have to be cognizant about a couple of factors here. One is we know that we are coming from a scenario where risk weightages had turned higher for NBFCs. But alternatively, on the positive front, the liquidity constraints, the liquidity scenario is sort of turning in favor of NBFCs. So, although risk weightages had risen, but given the fact that liquidity scenario is supportive and juxtaposed to that repo rate cuts, I think that definitely bodes well for NBFCs as far as their funding scenario or funding situation is concerned. So I think if the funding scenario is slightly turning favorable, then highly likely we'll see transmission also happening through yields. So ultimately, the consumer should definitely benefit. As far as, like I mentioned even earlier, in the interim periods, you will see consumer loans, consumer durable loans, personal loans, vehicle loans benefiting more from the rate cut scenario.
Point taken. And Shweta, what about the outlook from an asset quality perspective? What's playing out? You're seeing some spikes in certain NBFC counters, microfinance in particular. It seems from a stock price perspective seems to have bottomed to a certain extent. What are your checks indicating both on microfinance? And I also want to highlight that in December 2024, Ilara, you guys came out with a report and suggested that CV might also be under some bit of pressure in quarters going ahead. Any concerns on any of these books and how do you see it play out?
Yes, so lead indicators definitely are building in a slightly positive scenario as we usher into New Year. I mean, we are already into New Year. But having said that, while headline buckets, so say 30 DPD, 90 DPD, headline GNPA still or headline delinquencies still remain on the higher side. But the good news is the forward flows or the delinquency flows into NPA pool, into write-off pool is definitely substantially declining. So that is a positive indicator in terms of anticipation of lower slippages. And therefore, we have started building in slightly modest credit cost going forward. Coming to sector specific scenario, so as far as microfinance is concerned, clearly the recovery is still 2 quarters away. Perhaps H2, beginning of H2 of FY26 fiscal will be a better, perhaps will provide a better picture on how things are turning around on asset quality front for microfinance. For now, delinquencies continue to remain elevated, although there has been improvement in collection efficiencies. But then it's too premature to sort of build a positive scenario there. CV financiers, you're right. We did some channel checks pan India, which are alluding to the fact that bounce rates or early delinquencies still remain on the higher side. But the growth scenario, so as far as vehicle finance growth is concerned, is slightly tapered. But growth scenario, as far as home loans, LAP, consumer loans are concerned, so there we are building in strong growth targets. So I think diversified NBFCs, even though likes of Chola, Shriram are CV focused, but their non-CV portfolio is going to drive growth. So definitely net scenario looks pretty healthy in terms of growth. Asset quality concerns remain, they still linger. But yeah, as we have entered into a scenario where incremental flows are curbed or have
Right.
been under control, so I think it paints a positive picture going forward.
Right, Shweta. Thank you so much. A positive picture overall, although asset quality remains a concern, but we're hoping that that eases down soon as well. And with that note, Shweta, thank you so much. We're running out of time, but we really do appreciate your time with us. And viewers, you stay tuned to NDTV Profit as there's a lot more lined up for you right on the other side.
That's huge. That is a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, कार हो या नियर, सब कुछ दिखे क्लियर.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
all packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has
Market stage a stellar recovery to trade near day's highs. Nifty gains roughly 350 points from the day's lows to trade about 23,650 mark. The Sensex also above 77,700 mark. Nifty Bank as well as the Nifty Finance and Consumption lead the sectoral action, while the Nifty IT bears the brunt yet again, this time backed by fundamental quarterly results. Angel One tanks in trade after a disappointing Q4. Income drops 21%, while the net profit is down more than 48% in this particular quarter. Waaree Renewables, on the other hand, is up 11%. After strong Q4 numbers, net profit soars 82% for the company. Nifty IT as a whole is under pressure after Wipro posts a weak Q4 weakness extends across the mid-cap players as well. Sonata Software falls over 7% after they've given an update and a Q4 revenue warning as well. All eyes on Infosys, though numbers are due later today. IDFC First Bank board approves a fundraise of 7,500 crore rupees from two of its investors. We speak to CEO V. Vaidyanathan to understand the rationale and more. ABB India making smart moves in trade, up almost 4% after international parents suggest stronger than expected order book growth in this particular first quarter of FY25 for the company. Overall, orders is up more than 5%. We bring you more details on the show. Hello and welcome. My name is Puneet Zaveri. You're watching Profit Buzzers right here on NDTV Profit. Let's first look at the market because we've seen a very positive move and so-called recovery essentially in the Nifty today. Currently trading at about 23,705. And we spoke in the morning on the F&O segment as well that while 23,300 was one of the key levels to watch out for in trade yesterday, we ended roughly about 23,400 odd levels. It's been a very smart recovery. It was about the next key level at least to watch out for was 23,600, and we've decisively moved past that as well. Let's also look at the contributors for the Nifty today because we've seen the banking names as a whole being very positive, specifically for essentially the Nifty, and we've seen ICICI Bank as well as HDFC being the top contributors on the Nifty today, while on the other hand, some pressure seen in the IT space as a whole, but it's not enough to drag the Nifty into red. So very positive move, almost 300 points now on the Nifty. Let's also look at the mid cap and the small cap indices as well, because across the market today we've seen some smart moves in some key stocks based on news flow as well as positive momentum from the traders. Mid cap 150 currently underperforming the benchmark, while the small cap as well we could see a similar reaction as well, and there you go, just about 83 points, 0.54% up. Let's look at the sectoral heat map though for the Nifty, and we've seen spoke about how the financials were in the top gainers in trade today. We've seen the Nifty Bank, Nifty Private Bank as well as the Nifty Infra up in trade today. Some pressure of course on the Nifty IT, and we'll discuss that during the show as well. Apart from that, just finally let's look at the Nifty 500 now, the gainers as well as the losers specifically, because we have seen a lot of moves. Sonata Software, we will be discussing that in the show. They released a press release yesterday effectively mentioning that its largest client will have some revenue degrowth in this particular quarter, so that will get impacted. Restaurant brand Asia, though, very smart move, 8% up after its QIP over the last month. Delivery also trading in the greens as well. GMM Pfaudler is the other one. Equitas Small Finance Bank is a surprise because we've seen the update for Q4 for the bank also. It's not the greatest, and there is expected some pressure on provisioning, but today it's up almost 5%. On the other side, just some pressure on the chemical name like Archean Chemicals seen on the BSE 500 as well on the losing side. We also have G. Chokalingam, who's joining, the founder and MD of Economics Research. Mr. Chokalingam, thanks so much and good afternoon for joining us. I just want to start off, with your view on the market, because we see very strong move on the Nifty today. How are you seeing the current levels of the market? And because you've seen some positive move on the banking names as well. So just to start off, your view on the banking names.
Yeah, first on market, this is what I've been saying for last few weeks. We did not panic on US tariff war, because the two economies which would be most impacted would be US, because almost everything getting into the country would be taxed at a higher rate. And second, China, everything it exports to America would be taxed heavily, multifold. So these are the two economies which would be impacted badly. And in between you have India. It is very safe because your domestic demand and IT service exports form 90% of your GDP. Our goods export is only 10% of our GDP, and within that 20% of overall exports to America. So only 2% of GDP is exposed to American export, and therefore we panicked and it was unwarranted. And I believe unless IT service exports are touched by US through tariff or non-tariff war, Indian market is going to see significant recovery. Added to that, global pain always leads to oil price crash. Oil is already down about 27%, which gives tremendous help to Indian market and economy. So coming to banking sector, most sectors, if you look at the Nifty or Sensex, you have about 8 broad sectors constituting these two benchmark indices like auto, cement, etc. Now, if you see these benchmark indices, sectoral constituents, most sectors have what I call single-digit growth syndrome. IT services expected to grow poor single-digit, the dollar revenue, automobile sales volume and single-digit, FMCG single-digit volume growth, then cement also single-digit volume growth. So among many of these sectors, when you see the single-digit growth syndrome, banking sector is the only sector still giving you optimism in terms of double-digit growth in the credit base. 2 days back, the most reputed domestic rating agency also mentioned that 11 to 12% would be the banking credit growth. So that is the reason the banking stocks are doing well, and I believe FY26 banking sector would be one of the few sectors to outperform both Nifty and Sensex by a significant margin. The other tailwinds are inflation rate crashing, and therefore you can expect a significant cut down in the interest rate. Oil prices down, that also would ease the inflation pressure. So FY26 will see aggressive rate cut as well by the RBI. So all this would mean too good for the banking sector. There will be marginal rise in the asset net NPA, but it is manageable if you see from which level we have come down from say 2017 or 18 financial year to now. There is tremendous progress that is not going to be disturbed. So therefore, banking sector will do well, and within that, most probably the PSU banks will do well because of the solid branch network, which is helping them to consolidate and retain the low-cost deposits, namely CASA. That has become the key trigger for performance now. So that's my view on the banking sector.
Right. And thanks, Mr. Chokalingam, for the detailed view. But let's stick with the banking space, because IDFC First Bank's board has approved a fundraise of up to 7,500 crores from two of its leading investors. Now let's go across to my colleague Harsh to understand who are these investors and how are the bank's plans to raise these funds and what could be the utilization going forward. Harsh.
where IDFC First is concerned, they've done a fundraise, 7,500 crore fundraise, around 4,900 crore to be infused by Warburg Pincus, around 2,600 crore by ADIA. So marquee investors coming in at 60 rupees a share. Now, in terms of how this is being done, it's been done through a CCPS, which is a compulsorily convertible preference share. Each preference share will be converted into equity share and therefore is equivalent to equity share. The conversion, post-conversion, Warburg will hold around 9.5% equity in IDFC First. ADIA will hold around 5.1%, and the book value currently is at 52.85 post the infusion of money that's come in, and therefore it's happened at around 1.13 times price to book. Now, one thing to be mindful of is IDFC First has raised money in 2023 and 2024 at far higher valuations, something to be kept in mind. They've raised at around 70 to 90 rupees a share. So again, that is one thing to be kept in mind. They've done around 6,500 crore of cumulative equity raise back then as well. But this fresh equity raise happening at 60 rupees at a price to book which is just about 1.1 times. So again, that's one thing which really stands out.
Got the view, Harsh, and thanks so much for giving us all those details. Mr. Chokalingam, coming back to you first, we spoke about the banking space as a whole, but IDFC, last three fundraisers, my colleague mentioned, at 95 rupees, at 80 rupees, and now at 60. What's your view specifically on the bank? Do you think that this fundraise will be beneficial? Should investors buy into the stock right now, or are you cautious?
I used to be very cautious before severe fall in the stock. But to be fair to the stock, now the stock is already down substantially. And in March quarter, the credit growth is also around 20%, which is substantially higher than the industry growth. The only problem is that, this bank used to grow upward of even 30% in the distant past. And because of the whole industry growing at around 11-12%, and also the base effect, the growth in business has moderated substantially, which is reflected on the stock price. And another big problem is that the new banks which started 3 decades ago, they had a very low industry credit base. When all ICICI, UTI Bank, that is Axis Bank, all these banks when started, including HDFC Bank, the industry credit base was around 7 lakh crore rupees, just 7 trillion rupees. Now it is upward of around 140 lakh crore, which is very difficult to grow at a solid double digit. And therefore, IDFC also suffers from that. The advantage which the other banks had, it could not have, this bank could not have it. Now, other problem is that the equity base. Its equity base is so huge, to command 2.5-3 times price to book value, it has to grow the credit by very big margin. I mean, much more than even this 20%, which is also very difficult. So, in a nutshell, yes, one can buy the stock definitely for 10 to 15% upside, because as I mentioned, the whole banking industry has a very good tailwind, and our IDFC Bank also would be able to benefit out of that.
So, Mr. Chokalingam, for the long term, what's your preference specifically? Is it mid-sized banks, or do you prefer large caps? And any names if you can mention?
Yeah. For short to medium to long term, I would prefer Bank of Maharashtra to IDFC First Bank. The stock is already down substantially, 35%. I think this is a great opportunity to buy the bank. I've been tracking the banking sector from 1992. But I have not seen such a small bank, which used to be a small bank, has grown its business, and also maintaining a superior asset quality. Very rare to see the progress. Once upon a time, it used to depend on government for infusing the capital for its own survival. Now it has come a long way. Net NPA is 0.2%. Hardly there are only 2 or 3 banks have that kind of net asset quality, net NPA, being very low. And such a best asset quality, only 2 banks have. And this point, the outstanding net NPA is a fraction of quarterly profits. So it is easy to make even zero net NPA. I would love the management considering that. And secondly, look at the low cost deposits. This is a bank which has not slipped down badly on retaining the low cost deposit. That is a problem for small to big bank now. And particularly the banks which have gone for digital business, they are suffering, and they understood the importance of having a branch network to retain the CASA. And there also it scores. and March business numbers are already out. And Bank of Maharashtra has beaten the industry credit growth by very big margin. And it looks very attractive. I think this is one of the finest banking stocks in the entire sector. And I may be wrong, it can beat most listed banks in this current fiscal year.
So very positive view specifically on Bank of Maharashtra from Mr. Chokalingam, but the IT pack as a whole, and you just mentioned at the start of the show, is under pressure. Let's pull up a Wipro and a one-year chart of Wipro as well, because it's not been something that's rewarded investors very well. Now the company is in focus after its Q4 earnings. Now the company mentioned revenue largely flat. That's what brokerages are also estimated, but essentially, it's the deal wins haven't transpired to revenue growth in this particular quarter. Margins, EBIT margins specifically at 17.3%. Now, while the deal wins were very strong in this particular quarter as well as for the year, they mentioned that $3.9 billion of total bookings in this particular quarter. That's up 13% on a quarter-on-quarter basis. The large deal wins at $1.7 billion. It's also up almost 45% on a quarter-on-quarter basis. But the revenue growth number is so disappointing, and the trajectory and the guidance for next quarter, it's come in at roughly negative 3.5% to a negative 1.5%. That's the range that the company has mentioned for Q1 of FY26 specifically, and that's disappointed investors across the board. Brokerages have also come out and cut target prices. We have Citi that has a target price of 215 from 240 earlier, and the one key aspect they mentioned is that FY26 is likely to be another year of revenue decline and the third consecutive year of revenue decline. So that's one of the key negatives specifically. We also have something like BofA, who's cut target prices to 225 from 260 earlier, and so has Investec to 250. So across the board, it's a disappointment from investors. It's currently trading at 17 times price to earnings from most brokerages. So it's attracted there, but the numbers don't support the growth metrics going forward. The other one that's in focus and will be in focus today is Infosys. Now, Infosys amongst the large cap is expected to have the most disappointing set of numbers in terms of EBIT margins as well as growth, because we are also seeing a salary hike component come in this particular quarter for Infosys, and hence we're not expecting too much of a growth. The only one of the biggest numbers will of course be deal wins, but the FY26 guidance expected to be between 2 to 5% for the next whole year of FY26. That's what Infosys is expecting, and most brokerages are penciling in that number as well. But Mr. Chokalingam, specifically your view on Wipro, how do you view the Q4 results? And now that the stock has also corrected, do you think that it's a better play compared with the other large cap peers?
Large IT stocks, as I've been saying repeatedly on this channel, that the wealth creation story is over. The IT export used to grow even 30-40%, about a decade ago, which has now come down to 2 to 4%. And some of these companies are stagnating or expecting stagnation in the revenue in dollar term for the current fiscal. So therefore, if one aspires to make a big wealth, that's in my personal view, most unlikely, at least for next 1-2 years. But to be fair to the stocks, they are already beaten down. Quickly they have come back to 52-week low from 52-week high. And as you rightly mentioned, the valuation also around 70, which is very rare to see in the past. Of course, that reflects the pessimism for the sector as a whole. So therefore, considering the valuation and also the fact that they are all already beaten down, I would say that stock like Wipro would be a hold for defensive investors. But little risk-taking investors can go for small and mid-cap IT stocks, because from 2014 to 2012-13, we saw a series of acquisition in the mid-sized IT companies, and that probably should once again get a life because of stagnation in the industry, whole industry. So from that perspective, one can look at small and mid-cap IT quality stocks and stay away from the large cap. But still, from defensive approach, one can stay, and I would prefer Infosys to Wipro.
Got the view, Mr. Chokalingam. The other stock that's in focus in the IT pack is Sonata Software. Now, the company came out with its a press release yesterday specifically, which has lowered its Q4 FY25 revenue estimates from its largest client. Now, international business revenue is expected to be lower in this particular quarter. That's what the company has said. And revenue is expected to be declining versus a little higher than what their estimate was. So they had anticipated a 3.5% revenue decline in Q4 of FY25. Now that its largest client has also mentioned specifically they are estimating lower revenues from the largest client, it might have a larger impact, maybe a 4 to 5 to 6% type of decline in terms of revenue now. And that's a slight key negative. We've seen the stock recover from almost down 12% to 6% now. But the largest client, we're speaking to multiple brokers, is actually Microsoft. And both LTI Mindtree as well as Persistent also are India vendors for Microsoft. Let's also pull up those stocks and see what they're doing in trade. Currently for Sonata, we have roughly about it was about $87 million in terms of revenue from the international business that was there. Persistent come back in the green again, but we've seen that kind of pressure now, and share of the international business is almost 25% for Sonata, so it's a very sizable contributing in terms of revenue as well as margins. Now for fourth quarter, the guidance, as I mentioned, it was 2.5 to 3.5% decline, might be higher because of this news now. And in Q3, they mentioned that the second half specifically of Q3 also had some unplanned rundown. So that's one of the key negatives on Sonata as well. Mr. Chokalingam, I'm not sure if you track the stock specifically, Sonata Software. Any view on the same?
Even after such a massive crash, for FY26, it would be trading at around 22 PE. I believe, if stock corrects below 300, then one can consider, because these kind of mid-sized companies can get re-rating and valuation multiple. They may not get a growth trigger, but there is a chance of valuation multiple getting re-rated. As I mentioned, by fag end of the current fiscal, the consolidation might get some life once again in the IT space. From that tactical perspective, I would give a buy recommendation below 300 on Sonata Software.
So below 300, that's the level to watch out for Sonata Software. But Waaree Renewables also posted about an 83% rise in its consolidated net profits for Q4 earnings. Stocks almost up 9.7% now in trade. Before we also spoke to the management about the quarter gone by. Let's get my colleague Mihika to talk to us about the key highlights about this particular quarter. Mihika.
It's been a good day for Waaree because Q4 numbers were strong. Earnings were aided by 76% higher EPC sales on an annual basis. Margins were impacted by 100 basis points on higher EPC contract, employee and other costs. But the company's order book, unexecuted order book, was up 38% YOY and now stands over 3.2 gigawatts. In terms of the top four numbers, revenue is up 74%. EBITDA has seen a 68% uptick. Margins have contracted by 100 basis points to 26.5%, and net profit is up almost 83% on an annual basis. The key reason why margins fell was a 78% rise in EPC contract expenses, a 51% rise in employee costs, and a 59% rise in other expenses. But execution for the company as a whole in FY25 was strong. It was up 15% year on year at 1,524 megawatt. This is surpassing the 1,500 megawatt target that the company had. And the unexecuted order book, like I said before, was up 38%, standing at 3,263 megawatts. In terms of their balance sheet picture, lastly, the total debt is now reduced at 27.37 crores versus 40.1 crores a year ago, and the cash and cash equivalent stands higher at 26.8 crores versus just about 9 odd crores a year ago.
Got the view, Mihika. Thanks for that. And Mr. Chokalingam, any chance you track Waaree Renewables as a space? Any view on the stock?
Yeah, long back we had recommended it, and then we closed the call particularly during IPO. I've been tracking it, and it's to be fair, the results are really very impressive. 57% growth in profit for entire fiscal year is really something impressive. But that is reflected in the P multiple also. It's trading around 50 times now on trailing basis. But my only concern is that competition in the renewable source has increased tremendously. There are many players starting from small cap to large industrial houses. So in this background, whether for next 2 to 3 years this kind of growth is possible to maintain, I have a severe doubt. So therefore, by any chance any profit booking comes and stock corrects 5-10%, then one may consider Waaree Renewable in my view.
Got the view, Mr. Chokalingam, and stay with us, Mr. Chokalingam. But with that, it's time for a quick break. But we leave you with a special ground report. If you used to use BlueSmart as an application for cab rides, well, you won't now, because if you have followed us for the past 2 days, we have been, bringing you extensive coverage of Gensol fraud. How is it impacting your cab rides? My colleague Tushar brings you this particular ground report. Take a look.
Why is BlueSmart in a spot of bother? Remember, BlueSmart is an EV ride-hailing company. Operations of BlueSmart, India's only pure-play EV cab operator, has come to a screeching halt after Gensol Engineering was pulled up by SEBI for misappropriation of funds. But first, let's explore what's the connection between BlueSmart and Gensol. Both BlueSmart and Gensol share a co-founder in Anmol Jaggi, the promoter of Gensol Engineering, who was accused of misappropriation of funds to the extent of buying a flat in DLF Camellias in Gurugram. BlueSmart works on a EV leasing model. Essentially, it gets all these from it gets its electric cabs from a EV leasing company, which acts as a middleman and sources loans from government institutions such as IREDA. These funds are used to then buy electric cabs and are then leased out to companies like BlueSmart. Given that they shared a co-founder in Anmol Jaggi, BlueSmart was a key beneficiary of these electric cabs at favorable lease terms. Now, with Gensol gone, the future for BlueSmart looks uncertain. Remember, BlueSmart was operating about 8,500 to 10,000 electric cabs on a daily basis and was doing about 20,000 rides per day on average. Its actually USP was catering to the airports in Delhi, Bangalore as well as Mumbai. The city operations were limited to Delhi and Bangalore so far. So essentially now what happens to BlueSmart's cabs? What we are hearing from sources is that a part of that fleet will be taken over by Uber, who will be running these cabs under its Uber Green wing. There were also talks of an acquisition by Uber of BlueSmart that we don't know where it is progressing at this particular point of time. There is also talk of a hybrid model where BlueSmart leases some of its cabs to Uber as Uber Green and itself operates a pruned fleet of its own. So essentially, BlueSmart, which was a good EV cab company, a look into the future of mobility, is now facing existential crisis.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL. In the last 1 month, if you see, the share prices of Gensol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Camellias.
all packaged food companies should shut down. Packaged food as an industry, they've been telling us half-truth.
Welcome back. You're watching Profit Buzzers right here on NDTV Profit. Now, Nifty is the most resilient market, believes CLSA's Lawrence Blanco. Now, he has mentioned that, a break above the 200-day moving average would trigger a very bullish implication on the Nifty going forward. He's also mentioned specifically that, on the upside target, he has roughly 26,427 to 26,430 as one of the key, positive benchmarks for the Nifty going forward. Specifically, we've also seen that, it mentioned that this was essentially moved back to the September highs that we had on the Nifty, from where we've actually seen roughly a 10 to 12% correction. He's also mentioned that, certain top stocks such as HDFC Bank, ICICI Bank, as well as Bharti Airtel as one of the key top picks for CLSA as well. And let's also look at the Sensex, because we made a very decisive move over 78,000 now, as highlighted at the bottom of our screen as well. And we're seeing over the last half an hour or so, the markets moved up really strongly, both on the Sensex as well as the Nifty Bank as well, now decisively above the 54,000 mark. And ever since, the last 6 months, we've seen a very strong move on since this correction, essentially since I think the level to watch out for on the Nifty Bank was 50,300, well above that number and almost 1,000 points. Let's also look at the Nifty Bank contributors as well, because seeing very resilient up moves specifically from HDFC Bank as well as ICICI Bank on the Nifty Bank. Let's look at the contributors now for Nifty Bank specifically, because that move on all these stocks above 1900 for HDFC Bank, we're also seeing SBI contribute very positively as well. Something like Axis also doing very well. So very strong day for the banking as well as the financial names as a whole. On that note, we have Mr. Chokalingam, but also let's welcome in Osho Krishnan, who is the senior research analyst, technical as well as derivatives at Angel One. Osho, let me come to you first, specifically on the Nifty Bank. Very strong moves that you're seeing on the index. Any kind of view that you have on the index as well as some of the key stocks, HDFC, ICICI, what to watch out for?
Very good afternoon to both of you, and firstly, thank you for inviting me at the show. Well, yes, Bank Nifty has seen a very strong movement in the entire week. It has been a truncated week, but for the whole 3 days, Bank Nifty have seen very strong outperformance. And the time we witnessed a breakout above the zone of 52,000, it was indicated that market can see a very strong movement from here onwards. And looking at the overall sentiments that was building up from past few trading weeks, that financial were having a very positive traction. Private sector banks and something from the PSU banks also have started contributing to the upside march in the Bank Nifty. So I'm expecting that with the kind of a momentum that we are into, Bank Nifty has a very strong potential to retest the 52 weeks high, which is approximately 54,400 kind of a zone. Because looking at the Fin Nifty has already achieved a fresh lifetime highs, and Bank Nifty is approximately testing the same zone. So I'm expecting that in the coming period, there is a high possibility for Bank Index to have a very positive stance from here onwards. Now, coming to stock specific front, today ICICI Bank and HDFC Bank both have given a very strong breakout, and they are at a 52-week high. So I'm expecting that in the coming days, there is a very strong potential for these counters to have some kind of outperformance in the market, followed by a strong backup that has been provided by the PSU banks also. So one should not leave out the banks like CUB, Indian Bank, Union Bank. All these counters are looking very positive to me. And even from investment point of view, these counters can be seen as a good opportunity to buy here and get a decent return over a period of time. So overall, BFSI as a sector is looking very positive to me. And from here onwards, I am having a bullish approach for the coming near future, in the coming future.
So 54,400 is the level that Osho is watching at from the Nifty Bank. And both HDFC as well as ICICI will be in focus. Their results for Q4 expected this Saturday. Another stock that's in focus is Angel One. Now, it has been in the spotlight as the stock has recovered from the day's lows after reporting a subdued quarter. Now my colleague Harsh joins in with key highlights from Angel One's quarter 4 earnings.
Well, tough set of numbers for an Angel One. You saw a 16% contraction sequentially on the revenue number, 22% YOY. Employee expenses were the one place where we could see some bit of calibration, due to which the profit after tax was in line. There was some one-off savings in the employee expenses which has led to this in-line kind of profitability, but outside of that it's been a tough set of numbers. New initiatives are seeing good traction. They've added Axis Bank, IDFC First Bank as partners for credit distribution. They've also witnessed a slowdown in their credit disbursements in Q4 versus the 9-month FY25 period. They're expecting credit distribution to see a ramp up in FY26. So that's from an outlook perspective. The FY25 earnings were weak due to multiple headwinds. The impact of these headwinds will come in versus the base in Q4 FY26. So something to be kept in mind, but otherwise the earnings growth will likely remain weak or muted. That's what brokers are expecting, likely to remain weak at least in the near term where Angel One is concerned.
Well, thanks for that, Harsh. Mr. Chokalingam, your view on Angel One's quarter 4 earnings, if you had a look?
Yeah, I just now analyzed it. After the fall, it looks quite decent. Definitely, it may not create a significant alpha, but 10-15% upside is very much possible. Yeah, Q4 result is bad, but that is expected for all the players who are related to stock broking business and wealth management. Jan-March quarter was one of the worst quarters in the recent period for this particular business. So now with the market expected to recover, these businesses also should recover. So therefore, from current level, definitely 10-15% very much possible.
Got the view, Mr. Chokalingam. Now, ABB India is also up almost 4% in trade after the global parent actually reported its earnings for quarter 1. Now, specifically, we are anticipating, there were a few numbers going around. Let me bring in my colleague Anushi to contextualize all this and more for ABB.
Right. So what we are looking at is ABB is in focus in trade. ABB India is in focus in trade after the group company, that's the ABB global parent, has reported its Q1 numbers for the quarter. Do note that the company follows a January to December calendar year, so it's the first quarter numbers that we are looking at. So what has happened is that for their India business, they've seen about an order inflow growth of 1%, which is a positive, considering that the last quarter there were discussions on there being slowdown on order inflows. So order inflows above expectations is something that we are looking at. Other than that, if you look at the earnings side of ABB Global, they reported a 3% of a growth in their revenues. This is lower than what was the guidance given for a revenue growth to be in the mid-single digit, but it was the margins which were a standout for this quarter, wherein margins are about a 230 basis points of an improvement at 20.2%. This is above the guidance that the company had given, wherein the expectation was that the margins will remain broadly stable. So this was led by pricing, positive pricing that we are seeing, leading to this kind of a margin impact, that margin improvement that we are looking at. Overall orders, if we see not just the India orders, they were up around 5% at $9,213 million, again higher than what was the expectation. Now, just to contextualize how the order growth has been in terms of trends for ABB Global versus ABB India, if we see that ABB India, whenever a group has seen a decline in their growth, like minus 21% in the fourth quarter, we did see about a minus 14% of a dip in the ABB India business as well in terms of where the order inflows are concerned. Similarly, in when the order growth has been stronger for the business, ABB India has reported even stronger growth picture over here that we can see in quarter 3, quarter 4 performance, quarter 3 and quarter 2 performance as well. In the first quarter also, the company had reported a 5% of a growth in their ABB group. The ABB India business had reported a 15% of a growth. So this is in terms of how the trends have shaped. So focus would be on how ABB India's order inflows for the quarter would be. If we go look ahead, the company now sees more uncertainty for its global business environment. However, they have retained the CY 2025 outlook that they have given, wherein the revenue is expected to remain in the mid-single digit range. Book-to-bill ratio mainly will remain in positive. This time the book-to-bill ratio stood at 1.16 times. and there would be further expectations of improvement in the EBITDA margin. In other business updates, so the company has stated that it plans to spin off its robotics division and is expected to separately list its robotic division in the second quarter of 2026. So this is what we are seeing for ABB.
Got the view, Anushi, and thanks so much for that. But we've seen a very strong move and up move in the market today. We're also getting joined by Mr. Mihir Vora, who's the CIO of Trust Mutual Fund. Mr. Vora, thanks so much for joining in. We've seen a very sharp move and on a positive side, specifically for the Nifty 50. Any view that you have specifically currently on the market?
Sorry, you're asking of the Nifty?
Yes, we've seen a very strong move in the market. The bulls have come back in a sense, and we've seen the banking and the financial names specifically, which have been one of the key reasons for the growth today in the market and the prices as well. What's your view specifically on the banking as well as the market move that you're seeing currently?
So if you notice, India has been among the few markets which are actually above the pre-2nd April Trump tariff levels. So I think it's a testimony to the fact, and probably the FI is also realizing it, that India will probably be the least impacted. There will be an impact, of course, on exports, etc. But relative to the other countries in the world, India should be amongst the least impacted. That's one. Second is, typically we have seen in most of the crises, it's ultimately the Indian consumption story remains very, very solid. And India does tend to rebound also quite well after most global crises. So I think India's relatively lesser dependence on exports is one. Second is the overall RBI policy approach also has now turned more dovish. So we are seeing liquidity come back into the system locally. And third, I think most importantly, for the first time in history, we are seeing that all the problems that are typically associated with emerging markets are actually now being associated with the US. So we are talking about inflation there. We are talking about the dollar depreciation. We are talking about bond yields going up in the US. So typically in a crisis, all this used to happen to emerging markets in India. Now it's the other way around. So probably we are seeing some more FI buying after the last 2 days. The cash market buying from FIs has been positive. And maybe I don't have the numbers, but I guess that buying still continues from the FI side. And domestics were anyway buyers continuously. So to that extent, I think we are seeing some kind of a relief rally after the huge volatility that we saw after April 2nd.
Fair point, Mr. Vora, and you highlighted that India is definitely looking better when compared with the other countries in terms of the tariff impact, as well as RBI's very positive moves. I also wanted to get your view on the banking names, because we've seen almost 1,000-point up move on the Nifty Bank, and just a precursor to the Saturday results for HDFC as well as the ICICI Bank. How are you viewing the banking space as a whole, and some of the key expectations from Q4, if you have any?
So Q4 expectations are not that great, frankly, because we haven't seen credit growth pick up that much. And the impact of the RBI liquidity and rate cuts will now start being felt. So my guess is that the markets are kind of preempting that move. But most importantly, banking as a sector did not do too well in the last couple of years for good reasons. You had the liquidity tightness, you had the RBI clamping down on unsecured loan growth, and you also had the volatility linked to the currency, etc. So banking in general had underperformed. So relative valuations of banking and the large NBFCs had become attractive in any case versus the rest of the market. And now that all those factors are being unwound, rupees stable, liquidity is ample, RBI is cutting rates, I think we are seeing the markets preempting growth coming back into the system, because growth was the only thing missing. Credit quality, capital adequacy, etc. were all fine.
Fair point, Mr. Vora. And also I want to understand, your view specifically, from the growth going forward. Where are you anticipating, in this particular quarter, which were the sectors? Because we've seen the auto pack getting impacted slightly because of, the Trump tariffs. Banking, you spoke about the Nifty IT, not too much great, coming in from that news and from TCS as well as from Wipro. So what sectors do you think specifically do we look at going forward? Because we've seen the market reacting to, as you rightly mentioned, some earnings coming forward. So what's your view on which sectors do we watch out for going forward?
So as you said, the March quarter earnings are not going to be anything great in any case. Single-digit earnings for the large caps, earnings growth for the large caps. So we will have to look forward, and there all the domestic segments look fine. We already discussed banking. Then we are talking about even the domestic cyclicals like industrials, etc. coming back. We do see government ordering supporting that, and hopefully with manufacturing in India gaining prominence, probably we can see the industrials also done well. Power, railways, defense, anyway were segments where government has been focusing on. There was a bit of a let-up in ordering, which led to a sharp correction in the stock prices. So these are some of the segments which will recover, I think, as we go forward.
Good afternoon, Mihir. Hiral this side. Mihir, the kind of rally that we are seeing right now in terms of where markets go, I mean, something which probably the street was slightly nervous about. However, the upside is looking fabulous. Do you think there is confidence which is coming back in the markets, number one? And secondly, it seems that the FIs probably are seeing some bit of short covering in terms of their strategy. How are you looking at it?
I think there's no euphoria as of now. I think people are still worried about the volatility. So we are not really in for a completely bullish view from the market participants. So there is enough, I would say, enough steam left because there is still a healthy dose of skepticism in the market, I would say. And I would agree with your view that some of the value might also be driven by FIIs who are short on the market in the futures segment, in the derivatives segment. But it also may be some amount of reallocation coming back to India after what we saw in December, January, Feb, where some money had actually gone to China, and people are talking about India versus China, etc. So maybe some of that rebalancing trade also might be happening. And if that continues, we should see some more money coming in from the FIIs.
Here, hi, Tamanna here. Great to speak to you on what is turning out to be a very exciting afternoon with volumes coming in. From an India perspective, a sense now that comparative to China, as these reciprocal tariff rates keep getting higher and higher, that India is going to be the destination. In that sense, do you even see foreign investors returning, or this is going to be largely a domestic story?
I hope they come back, Tamanna, and put a smile on our faces because they've been selling for so long now. September, October, November, December, January, February. I think March was the first month after 6 months that we saw some net buying by FIIs. So they already seem to be underweight India, and even if they want to make it neutral versus China, etc., we should see some good money coming in. Another statistic that we keep discussing is that calendar year 24 was a year where, on a net basis, FIIs were sellers. And statistically, at least historically, what we have seen is we haven't seen FIIs being sellers for 2 consecutive calendar years in the last 25, 30 years. So hopefully that track record won't be broken, and FIIs should end up being net plus by the end of calendar 25.
Thank you for that, Mihir, and always a pleasure to speak with you. We're getting more voices in on this Thursday afternoon. I mean, the kind of up move and the volumes with which it has come is truly astounding, and it's clearly the banks leading the charge. In fact, that's the first question I'm asking Abhay Agarwal this afternoon, Managing Director of Piper Serica Advisors, who's joining in. Abhay, great to speak with you. The faith that we're seeing in banks ahead of key results this weekend, what is that telling you? Because yes, we have seen interest rates dipping. They're going to continue to dip. But the transmission cycle is not necessarily giving us a great story for banks. Why do you think banks are leading the charge?
Yeah, I think, thank you first of all for having me. In our model portfolio rebalance that we did in this quarter, we have added 4 banks, and that is after not having any banks in the portfolio for almost 18 months. We tracked the sector very carefully, and I'm not surprised by this up move, and it is a lot to do with a reversal in a lot of things that put banks under pressure. The primary one being the restrictions that were imposed on lending to unsecured segment starting from January last year by RBI. And I think that sucked away a lot of liquidity. And if you look at MFIN data, the unsecured lending as a pool by banks fell from 4,50,000 crores to 3,70,000 crores. So there was a lot of pressure that banks took in terms of asset quality because of very strict NPA recognition norms. Provisioning was high, especially in the December quarter, because a lot of people who could not pay on time were tagged as defaulters and provided for when they were not really defaulters. So I think a lot of those things are reversing very quickly. The new RBI governor that we have clearly has given a very strong signal to the market that they will be supportive of liquidity and a lower cost of capital and focus on growth. So I think I'm not surprised that investors are looking at, especially the smaller banks that are trading at book value or some below book value, to make their bets now.
An interesting point that you made is where investors are actually watching out for the smaller banks. How are you looking at the kind of volumes you're seeing today? I mean, in terms of HDFC and ICICI Bank, because in terms of opening trade today, volumes have been super strong. Saturday is when both these banks will declare their results as well. How sustainable is that going to be? Because again, to some extent, the anticipation is that there could be profit booking in the last hour of trade with both these banks as well, just before the earnings. How would you look at this large cap banking space then?
No, I think large cap banking space, we are very positive. I think a very strong technical and fundamental bottom was made in large cap banks in the last quarter. We are seeing the technical and fundamental both becoming favorable for large banks. The volume-based buying that we are seeing, I don't think is going to stop beyond the results. I'm expecting the commentary from the banks to be positive after a long time. I think last 2-3 quarters we saw the commentary being cautious, which was rightly so, but I'm expecting that the banks will signal that the worst is probably behind, and then we are getting into a cycle which has lower cost of capital, better credit offtake, and better margins. So I think that's what the markets are also anticipating, and I don't really see these stocks correcting. Of course, there will be profit booking, that's part of the course, but I expect the trend to be upwards over the next 12 months.
Mr. Agarwal, it's Puneet here joining in as well. Thanks so much for joining in. You mentioned that you added 4 new banks in your model portfolio. Any names that you can suggest? Is it only private banks, or have you added any public sector banks as well?
We are still adding them, so the names are not yet public, but these are, our focus is more on stocks there where we can benefit from a multiple expansion also. So these are all private small finance banks.
That's interesting. That's interesting because your microfinance or your asset quality question, which has been plaguing the space, seems to have receded. So a couple of factors, Abhay. I'm just trying to, let's zoom out a little and look at the big picture. CapEx rollout expected to pick up. Consumption expected to pick up now that the tax incentives announced in the budget are going to start kicking in, and maybe a distinct advantage for India versus China, for example. If I were to, off the top of my head, think of 2-3 reasons for this rally, would this make your list?
You're talking about the banks per se, or generally?
No, overall, reasons for this rally.
No, I think, as I said, and I've been saying this also, that the correction that we saw in India especially was very sharp, very vicious in the last quarter, starting January, February, and part of March also, because of various fears, domestic slowdown, FPI selling, and a lot of those reasons have reversed also as quickly. You have seen the US dollar correcting, the US assets becoming less attractive. So we are seeing, more conversations from foreign investors coming into India after a long time. Fundamentally, things are improving, better, lower taxes, lower interest rates, domestic consumption coming back. So I think every which way I look at it, I'm pretty confident that there are very solid technical and fundamental reasons for this rally to sustain.
Right. Abhay, we've spoken about the financial space. You have private banks, which is the top gaining sector today. But apart from that, let's look at two other sectors which have exposure to the export market to a large extent. Auto and pharma, both of them seeing a recovery in trade today. Now, you know, there is constant back and forth with regards to tariffs. How would you advise investors to now look at the auto and pharma space, taking into consideration the recovery that's probably coming in?
I would say on the auto, especially the four-wheelers, it's still a domestic story. And the good thing is that the stocks went through a sharp correction. Whatever channel checks we have done recently, there seems to be more inquiries. Some inquiries are also converting into sales. Price cuts that were taken in March and January helped a lot. So I think overall the demand environment for four-wheeler consumer vehicles, passenger vehicles is positive. On the export side, I think it's more of a two-wheeler story, and that also seems to be holding up pretty well. So I think autos is a segment that we haven't added yet to the portfolio, but we are looking at it actively to see what are the plays there. But on pharma, we are far more constructive. I think for the last 18 months has been an overweight for us, and we plan to keep it that way. I think the Indian large cap generic companies have done a lot of good work over the last 5 years, and they are in an environment where their hard work is getting rewarded in terms of the large product pipeline they have, especially for the US launches. The US FDA is very friendly to the Indian companies right now, and I expect that to continue to be the case. So I think for the pharma companies, it's a great environment to benefit from.
What would be some of the pharma companies you're really liking now, Abhay, to whatever extent you're, giving us direction on it?
In our model portfolio, we have two, which is Dr. Reddy's and Divi's. Divi's more so from the CDMO perspective. But at this point of time, I would say that if you look at last calendar year, pharma index was the best performing sectoral index in Nifty, and I'm expecting that to be largely the case this year also. I think people will be surprised by the commentary and the results that they see from pharma companies. So I would say that you can pretty much pick up any of these large caps and bet on them right now.
Interesting. So we'll take that point away from what Abhay is saying, that pharma is going to surprise on the upside perhaps this quarter as well. Thank you so much, Abhay. Always a pleasure speaking with you. Gautam Shah joining us now, founder Goldilocks Global Research. Gautam, very good afternoon to you, and it's turning out to be a spectacular afternoon, truly. Let's talk about the Nifty. Zoomed through several resistance levels. Where do you see it now? Closing in on 23,800.
Yeah, good afternoon indeed. When you see a stock like SBFC Bank at lifetime highs, you want to question whether we are actually in a bear market or not. Because I think we've had a very unique situation in these last 6 months, wherein the average decline in stocks on the NSE was about 42%. And you had so many stocks among the top 100, which really stood out really well. I think on the first signs of global stability, you have the Indian markets running away, because this 25,000 crores, which was just waiting on the sidelines, waiting for global stability, that has kicked in the last 2 weeks, and this is probably the reason the market has seen a V-shaped recovery. I don't think index levels are as important, because I think money is at work. People feel a lot more confident. Earnings have been quite reasonably stable. The slowdown talks have been discounted to a greater extent. India VIX has corrected, crude has corrected, dollar index have fallen. So there's a lot happening in the financial market framework at this point of time. I think one should remain constructive. I don't think the index is running away. 24,000, I think, is an important barrier where there could be a bit of a pause. But I think being in the right themes, being in the right pockets is important, and we love financial services. I think we've maintained that stance, and I feel it will go on to do much bigger things over the next 3 to 6 months.
Gautam, interesting point. I mean, 55,000 is what you're aiming for as well in terms of Bank Nifty. We're pretty close to those levels. Our chart's still indicating further strength, but HDFC Bank, ICICI will lead the rally to hit that 55,000?
See, I think we went through a storm in these last 5 or 6 months, and any sector and any stock in the market that withstood the storm has basically been the best participant of the rally in the last 7 to 8 days. I mean, if you look at ICICI, HDFC, SBI and Kotak, they just didn't, fall while the markets were collapsing, in those difficult times. And I think now money seems to be chasing them. And obviously, these are businesses that don't have much to do with foreign soil. I think that's probably the reason a lot of companies, which are more inward-looking and are India-centric, have done much better in the recent past. So I think there's a lot more upside. As I said, numbers are not important, but 55,000 near term, maybe a 60,000 over the next 6 to 12 months on the Bank Nifty, entirely doable.
Gautam, it's Puneet here joining as well. Thanks so much for joining in. 60,000 on Nifty that you're looking at. I want to get your view on the PSU banks as well. Anything that you're seeing, the positivity of private banks there as well? And we've seen the mid-cap and the small caps not really participate in the rally today. Any view that you have on those, on both those indexes as well?
See, firstly, on PSU banks, I think they are on the verge of starting a new trend. I think in the last 15-20 days, it's been about the private banks, and rightfully so. But I think some of these top PSU banks are setting up beautifully on the charts. And I think the risk reward is excellent. The margin of safety is immense. You have some of these stocks which are trading at a PE of about 8 and 9, and they have nothing to do with these, talks around tariff and the global uncertainty. So I believe that this strength, which has been in private banks, will trickle down into the PSU banks, and the top 3 names, we like, and I think we recommend your viewers to look at investment positions there. Talking about mid caps and small caps, I think it's very selective. It's not a kind of market environment where anything and everything would do well. I don't think that can happen. It's top quality which is participating, and this is going to continue. So large caps might take a breather after we hit a level of, say, 24,000, but the mid cap, small cap outperformance, I think, will continue for the rest of the year.
Top 3 names there, Gautam, top PSU banks, SBI, which are the other 2?
Yeah, so the top 3 names are clearly SBI, BOB and Canara Bank.
Okay. And you think more steam in an HDFC, ICICI Bank after what it's been doing? Like you said, I don't know where the bears have gone and not looking for them to come back. But HDFC, ICICI Bank still looking like more steam ahead?
I think so. I think, they've just seen beautiful relative strength in these last 3 or 4 months. And I believe smart money was hiding into some of these stocks, and not to forget the Bajaj twins, the NBFCs, Bajaj Finance and Bajaj Finserv, which have also been quite solid. So I think the entire space will do bigger things. I mean, the advice to your viewers is don't look at profit booking very early, because we've gone through a difficult 6-month period, and I think there's definitely more to come on the upside. Markets are not going to run away. They will have their dips from time to time, but now we are going to get into a period of buying the dips and a period of higher tops and higher bottoms.
25 calendar year, what is the Nifty looking like for you? And I know I'm saying this at a time when the mood changes every 3 days, Gautam, but having said that, is there a number that you want to put out there?
Yeah, I think the mood can change. That's okay, because we live in a very fickle-minded world with so much happening on a daily basis. But, as a technician, I feel extremely elated because price action discounts everything, and discounts everything really fast. And I think we've gone through a bear market in 6 months that could have happened over 1.5 years. And because cycles have shrunk, it's good that markets have come back this quickly. And I think this is going to sustain. So while the Nifty might not give you great upside, maybe another 5-7% from here, as I said, it's a stock pickers market and theme pickers market. So we are very bullish on financial services even now. We like the entire PSU basket. We like the entire metals basket and the power in the infrastructure space. So if you're in these 5 major pockets, I think there is serious money to be made between now and end of the year.
And Gautam, we are talking about people who are already invested in these sectors. How about someone who's looking to make fresh investments at this current point in time? Are charts favorable for a new investor for the sectors that you're mentioning? Let's pick up metals first. And if so, any names that you would give?
I think so. I think the risk reward is justified buying into financial services and metals even now. I know people might look at the price action of the last 7 days and say that, oh, they've missed a rally. But I think the upside potential is far, far greater than the downside risk at this point of time. So I think as new investors, just because Nifty is at 23,800, please don't wait out. I think a lot of domestic money fund managers are also deploying money as we speak, and they're forced to because they see that, markets seem to have stabilized. So just focus on these 3 sectors and be a buyer even at today's prices. there could be a 2, 3, 4% dip at any point of time. We have a long weekend ahead, but I think one should not really wait too much for that.
Right. So I think this is a stock pickers market. There are opportunities for someone to make a fresh entry as well. That's the word coming in from Gautam Shah. Thank you, Gautam, so much for joining us on the show and sharing your views at a time when the markets are at the day's high, in fact, very close to their record high levels as well. Nifty 50 has actually erased losses with regards to 2025, Puneet, and that's an interesting one. We are about that 23,750 mark in terms of Nifty 50. And Bank Nifty has added nearly 1 lakh crore in terms of market capitalization. So it's the BFSI which is leading the space.
Well, definitely. And, before the results come in, it's a big positive move, something that market might be telling us already, like a preview going forward. But, the market news definitely continues. Nifty Bank levels, almost we crossed 1,200 points on the Nifty Bank, just seeing some correction there. But overall, very close to 23,800 on the Nifty now. But with that, that's all the time we have on this edition of Profit Buzzers. Thanks so much for watching. Stay tuned to NDTV Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They are saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
That's all.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor, Varsha. Well, Varsha, market continues to hover around the day's highest point. We have in fact crossed 22,800 point. Let's get in our guest for the show today, Avinash Gorakshakar, the Director Research with Profit Mart Securities. Avinash, coming to you first on markets, a strong up move that we have seen in the market, especially led by banking and the IT names. How are you looking at the market at the current juncture?
Yeah, good afternoon, Somik. My sense is, I think, the entire sentiment in the market has changed, after the fact that markets have realized that, the scare which came on April 2nd from the Trump tariff issue has now got normalized. I think, most market players are expecting that negotiations will happen, and obviously not immediately, but at least till September, things will be very clear. Hopefully, India will get a lower, tariff rate structure, and that goes positively for us. In fact, India, according to me, is a very protected market, offers a very solid growth kind of opportunity for, countries like Europe and US. So there is unlikely to be any major disruption, because of the tariff issue. And I think clearly with the dollar weakening, the rupee stabilizing, we have seen the dollar index also coming down. FIs have also started buying very small quantities, in the cash market. So that has given an added level of comfort and confidence. And I think, sectors like financials, public sector banks, private sector banks, hospitals, hotels, these are sectors where I think growth would continue. I think at least visible growth is there. And most importantly, of course, for the export sectors, although the headwinds are challenging, IT companies, we are going to see a little bit of sluggishness in numbers, which came yesterday from Wipro and earlier TCS. And today, Infosys. I think, normally markets would re-rate these stocks only when there's a clear hint of visibility of growth coming in. So maybe the IT sector, maybe for that reason, the pharma and the metal pack may remain cloudy, but I think there are some good sound bets in this sector also. So I think, my gut feeling is that numbers for the fourth quarter are important, but the real improvement in the market sentiment will further get re-rated once the April to June quarter numbers come in, because that's the time when you could see some impact of the rate cuts, of the budget announcements. And I think we are positive and constructive on the market. It's a good time to look at good quality companies and, start building your portfolio, because I think now at least the panic has gone out of the market and, liquidity is slowly coming back to the market.
Right. So thank you for that. But let's move on and let's see how Waaree Renewables has performed when it comes to Q4. It posted about 83% rise in its consolidated net profit on account of higher income. Before we speak to the management about the quarter gone by, Mihika joins us with the highlights of the quarter.
It's been a good day for Waaree because Q4 numbers were strong. Earnings were aided by 76% higher EPC sales on an annual basis. Margins were impacted by 100 basis points on higher EPC contract, employee and other costs. But the company's order book, unexecuted order book, was up 38% YOY and now stands over 3.2 gigawatts. In terms of the top four numbers, revenue is up 74%. EBITDA has seen a 68% uptick. Margins have contracted by 100 basis points to 26.5%, and net profit is up almost 83% on an annual basis. The key reason why margins fell was a 78% rise in EPC contract expenses, a 51% rise in employee costs, and a 59% rise in other expenses. But execution for the company as a whole in FY25 was strong. It was up 15% year on year at 1,524 megawatt. This is surpassing the 1,500 megawatt target that the company had. And the unexecuted order book, like I said before, was up 38%, standing at 3,263 megawatts. In terms of their balance sheet picture, lastly, the total debt is now reduced at 27.37 crores versus 40.1 crores a year ago, and the cash and cash equivalent stands higher at 26.8 crores versus just about 9 odd crores a year ago.
Well, thank you, Mika, for all the details. In fact, we spoke to Waaree Renewables Group Head of Finance, Abhishek Parekh, about the company's bidding pipeline for EPC segment. Listen in.
Our current order pipeline, the total bidding pipeline which we call for our EPC revenue, is around 30 odd gigawatts, which last year was somewhere around 20 odd gigawatts. So at 30 gigawatt of order book, we believe we have a reasonable pie to look at, because we have been consistently maintaining our market share also. And year on year, our pipeline increases, and we have seen the impact coming into our order book as well. So difficult to give an exact number, but I can tell you our order pipeline and our overall bidding pipeline has increased significantly in last 12 odd months.
Well, that's what management has to say when it comes to bidding pipeline about the company. But Avinash, this in this space, in the EPC space, we've seen a lot of increase in competition. You have water infra companies, you have solar EPC companies. Just wanted to have your view on the sector as a whole, and of course on Waaree Renewables.
No, I think Varsha, competition is definitely there, but I think it's all a business of volume. And I think as the company management disclosed, the kind of order book Waaree Renewable is sitting on, I think at least for the next 2 years, the revenue visibility is intact. Although, in this quarter, that is the fourth quarter, also we saw that top line and profitability in absolute terms grew. There was some pressure on the profitability margin. So I think, it's obvious that in a volume-based kind of business, margins will be under pressure. But typically, I think if you look at Waaree Renewables, I think the better part is that, they're also looking at an integrated approach. They're looking at putting up their own solar cell facility. So, going forward, such companies which have got an integrated approach are definitely going to benefit significantly. And I think even in the US, they have a US facility. So my sense is, I think, the Indian story will continue because the Indian government has been pushing for solar and renewable energy in a big way, and that is unlikely to change. So I think clearly, despite the competition within the solar EPC players, I think the market pie is very large. It's growing quite significantly in double digits. So to that extent, somebody who wants to take a view on this company has to take at least a 2-year view. These companies cannot be evaluated on a quarter-to-quarter basis and on a short-term level. I think longer term, the management bandwidth, the order book, all boils down to the fact that there could be a good risk reward provided one takes a 2-year view.
Right, on to an NDTV Profit exclusive now. As global trade war heats up, there's a rising trend of FDI interest in India as global giants look at the possibility of setting up manufacturing base in the country. My colleague Shrimi joins in with more details on the same.
What we have been given to understand that the government received 20 plus foreign direct investment related queries in past 2 months from global firms to set up manufacturing base in India. And these queries, spanning in sectors, particularly chemicals, automobiles, textile, electronic, which has huge, export potential. Sources, in fact, also telling us that these foreign players are restructuring their investment strategy, looking to diversify their supply chain in India. And, this surge in queries are, particularly driven by the lower tariff environment, which India has at this point. After pausing this entire tariff scenario, we have at 10%. Some of these actually FDI application also involve, joint venture with minority China stake. And in fact, some of the proposal do suggest that they want to structure the company in a way in India as far as joint venture is concerned to comply with all the India's FDI policy on investment. So sources also, indicated us that government has approved 7 to 8 joint ventures in non-sensitive sectors. And they are saying that this entire tariff move by US has acted as a trigger to this, prompting, global companies to rethink on their, supply chain and explore India as a stable alternative. Plus, India offers a competitive edge over the global peers is what also they're indicating. And the kind of scheme we have, like PLI scheme, is also a key factor to drive interest. So overall, yes, global firms is what the indication we're getting, that revisiting their investment strategy amid this geopolitical shift and trade uncertainty. Many these MNCs companies are recalibrating their strategies as a part of broader global realignment. Back to you.
Thank you so much, Shrimi, for all the details. Well, moving on, Morgan Stanley has also cut target price for major players from the metal sector. Let's get in Mika who will give us more details on that.
So Morgan Stanley has downgraded the ratings of 3 of the 4 metal counters that it currently tracks. Tata Steel, JSPL, JSW Steel, all of the ratings from an equal weight earlier have been downgraded to an underweight. In terms of sale, it's maintained at underweight. Now the new target prices for Tata Steel indicate an 8.8% potential downside. JSPL has a 5.4% potential upside, while SAIL has a 21% potential downside from the previous closing prices. In terms of why MS is downgrading steel, well, tariff-related uncertainty has boosted global growth concerns, and this could weigh on global commodities demand as per the brokerage, and they do see a downside risk to steel prices even if the government implements a safeguard duty of 12 to 15%. On Coal India, it has downgraded the stock's rating to an equal weight from an overweight. The target price has been cut to 450 rupees from 525 rupees previously. In terms of why they are downgrading Coal India, well, slow growth in India could affect the company's volumes, and weak global prices could affect the e-auction prices. Lastly, in terms of what does Morgan Stanley prefer, the brokerage does prefer cement because it expects domestic commodities to do better versus global.
Well, Avinash, how are you looking at the entire metal space, and what is your preference? Is it the ferrous or the non-ferrous? Do you prefer Hindalco or the steel names?
Well, I think, Soumik, we are very selective on the metal sector, and I think within the metal pack, one of the most stable and decent cash flow earning companies player is Hindustan Zinc. We have been seeing that zinc prices have started firming up. Hindustan Zinc, incidentally, is the third largest silver player, and it contributes almost 35 to 40% of the EBITDA to Vedanta. So, here, the best part is that if silver prices continue to rise, our sense is that we could see better numbers, at least, not only for the March quarter, but even for the April to June quarter. And I think they've also decided to expand their capacity. So in terms of their EBITDA margins, in terms of their operating cash flows, in terms of their, dividend payouts, I think this could be a good bet, for the medium to long term. Probably a price of 490 to 500 is very much possible, provided we see firmer prices for both zinc as well as for silver. So I think within the metal pack, we believe that, unlike a Hindalco or a Tata Steel, where there could be little more volatility, here I believe, the price point is definitely attractive, and I think that would give a good tailwind to the company in the coming year.
Well, Avinash, thank you so much, for joining this conversation. Good to have you. Moving on, Soumit, Morgan Stanley is actually bullish on Adani Ports. What do you have?
Well, yes, it's a very interesting note that has come out from Morgan Stanley's house, and that's on Adani Ports. Now, they have maintained their overweight rating on the stock and have marginally increased the target price to 1,418 from 1,415. But this is an interesting note because they are quite bullish on Adani Port despite the tariff issues that we are seeing. Now, what the brokerage house is saying is that they say that Adani Ports has a resilient business model with diversified cargo and geographical mix. They are saying that in the medium term, India is likely to gain the global share of goods export, which bodes well for Adani Ports' cargo business growth. And they're also saying that the currently announced tariff structure, in that positioning, if you look at India, stands much better. India is much better placed as compared to other larger Asian exporting countries. And at the same time, domestic leading macro indicators are also quite positive, and all these factors bode well for Adani Ports as per the brokerage. Now, they see that there is a limited impact of tariffs given the well-diversified cargo mix, larger share of sticky volumes of Adani Ports, and limited direct exposure to the US market. In fact, as per the brokerage house, Adani Ports has less than 5% exposure to the US. So not much of an impact that could come in because of the tariffs that have been imposed by the US government. They're also saying that apart from this, there is inorganic growth and new capacity addition, which would also bode well for Adani Ports and could offset any impact that could come in from the tariffs in the future. Apart from this, they're also saying Adani Port is expanding its integrated business model with continued investment in both port capacity expansion and logistic value chain. And they're saying that company continues to gain market share, and their strategy to leverage into integrated business model is also quite encouraging. So quite a positive note that has come out on Adani Ports. But shifting focus from Adani Ports to Infosys. Now this Infosys will be coming out with numbers today post-market. Let's get in, Puneet, with what is the street expecting out of Infosys Q4 numbers?
Well, thanks for that. It's expected to be a subdued quarter for Infosys, and that's expected to be the lowest growth across the large cap peers specifically, expecting revenues to just slightly rise by 0.9%, while the EBIT is expected to fall by 2.4%, and that's because this is a quarter where the salary hikes are going to be anticipated to come, and that's going to affect the EBIT margins, coming at falling by 71 basis points at 20.63% is the expectation for EBIT for Infosys. On profit as well, it's expected to fall by 1%, coming at 6,700 crores, and one of the likely things will be 100 to 150 basis point impact on EBIT margin, specifically because of salary hikes. Apart from that, we are also anticipating growth to be affected because of larger impact on consumer discretionary spending in the USA. Commentary as well as guidance for next year is expected to be roughly 2 to 5%. Both Nomura as well as Nuvama brokerages have anticipated their growth for FY26. So guidance number will be something to watch out for. Attrition on a year-on-year basis will be slightly higher, but I think the guidance in the deal wins as well as some commentary on if any delays that they have seen and project delays will be something to watch out for going forward.
Well, thank you, Puneet, for that. With that, it's a wrap on this edition of Top Trades. Stay tuned and keep watching NDTV Profit. India Market Close up next.
That's huge. That is a biggie. It's out of it.
Gold Class Clear Glass. Far ho ya near, sab kuch dikhe clear.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street, that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its
Good afternoon and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Mahima Vajrajani, and it's been a fabulous week of trade. In fact, the last 4 trading sessions we've been in the green, and today again we've seen a rally. We were flattish at the start of the day. Let's pull it up in terms of the intraday chart, and largely driven by the Nifty Bank, as you can see. We were flattish at the start of the day, and now we're 1.8% higher. Now staring in at 24,000. We've been in a week where we've gone nearly from 22k to 24k, and it's largely led by the banks. We're just 70 odd points away from life high on the Nifty Bank. That's something to watch out for as well, and hopefully we'll see it in the next 1.5 hours, and we can probably quickly cover it as well. Let's look at the heat map on the index. At least the momentum indicators seem to suggest that banks are the place to be at this point. 5% higher on an eternal, but look at an ICICI leading the charge among the banks, and SBI is up 3.5%, Reliance up 3% as well. So some of the heavyweights there carrying the load. But let's not forget there's an Adani Ports as well as a Bharti silently up 3.5%, those two as well. While not heavyweights on the index, they are certainly pulling a punch. Let's look at how many stocks are 1% plus, and it's 28 stocks which are gaining 1% plus in trade. Even a Kotak and an HDFC up 2.5% and 2% respectively. So it's a day when the financials have really taken center stage. Let's look at what's not doing well. Steel, coal, a Wipro on the back of numbers being disappointing in that sense. No deal wins, or rather the deal wins more subdued than expected. Let's look at the contributors on the index as well. And within that bucket, you'll see banking really contributing well. The heavyweights in general are also doing well. Far and few in terms of losers, and therefore we are up 400 plus points on the Nifty. Let's look at the advanced decline if we can, and what we'll again see is a bit of choppiness at the start of the day, and thereafter the bulls have really again taken charge, and the breadth of the market continues to be positive, and that again stands out, especially in the last 4 trading sessions. We gained 2% Friday, 2% Tuesday, and now we're nearly 2% higher even today. So 4 consecutive days and solid days at least in the green, and that's how it's played out. So that's the positive. But broader markets, Mahima.
Right, absolutely. So the broader markets are also pretty much sanguine. Also, I mean, not to the extent that the benchmarks have, the fashion in which the benchmarks have recovered, but in terms of the mid cap 150, it's up by about 0.7 odd %. The small cap 250 also up by about 0.6 odd %. Let's also take a look at what sectors are doing. Of course, Nifty IT under pressure, but Nifty IT has also significantly recovered. There was a point in the day where it was down by about 2 odd %. All sectors in green, and it has recovered to around 0.05% in the positive. Nifty Bank, of course, leading the pack up by about 2.4 odd %. Nifty Finance also up by about 2.4 odd %, followed by PSU Bank up by about 1.7 odd %. Nifty consumption doing well, up by about 1.4 odd %. Oil and gas, energy are some other counters which are doing pretty well in trade today. In terms of stocks and counters, amongst the universe of the total market, some counters doing pretty well in trade today include your nuclear software up by about 12 odd %, Fusion Microfinance up by about 11.5 odd %. Restaurant Brands is also up by about 8.6 odd %, and there are rumors being told about Restaurant Brand that Mr. Damani has bought in stake in the counter, and we're seeing the up move in the past 2 or 3 odd days. Significant up moves coming in Restaurant Brands as well. JTL Industries, Spandana Spurti, GMM Fodler are some other counters faring well in trade today, but some counters which have kind of cratered. And this is on the back, of course, earnings as well as everything that's happening across, the markets right now. There are counters like Wipro, which is not doing well in the Nifty 50 basket. And if you can also pull up the NSE 500 and see, what counters are doing well and not doing well. There's Sonata Software down by about 0.6 odd %, Wipro down by about 4 odd %, GSK Pharma down by about 3 odd %. So these are some of the counters, Harsh.
I'm surprised you've not taken Delivery's name. Up 7%.
9 odd % now, I think. Let's pull up that chart and see. It's 8.9 is what I saw, I think. There you go. No, it's 7%. Yes.
So 7% higher on a Delivery. A Fact is up 13.5%. Some Some fertilizer names really doing well in any case over the last couple of days. So fact also one of those. But let's quickly welcome on board Kush Bora, founder kushbora.com, to talk to us about markets and more. Kush, with regard to the Nifty 50, lots of zing in it today. What's the outlook going in? It's a truncated week. What's the outlook going into next week?
Hi, Harsh. I think greed is good. Yesterday we were speaking about how greedy you were being when the indices are taking a break. But no, I think funny things can happen on expiry, right? And then let's not forget today is also the weekly expiry for Nifty, and in all likelihood the call writers at 23,600, 23,800 have been taken to the cleaners. For now, let me start with the broader view, which is obviously that the tide seems to have turned, and the indices and a lot of sectors are participating, so it's definitely a bullish turn. But if you've traded for, let's say, the very near term, about a week or 10 days or so, and you're sitting on very handsome profits, yesterday I spoke about taking partial profits home. Today I would say book it out completely, because now we've gone into the zone of excesses where Nifty's also hit the overheated territory. Bank Nifty has gone too far into the overheated territory. So I won't be surprised to see some kind of a pullback coming in the next week or so. However, that decline should also be taken as a buying opportunity. But for now, irrespective of the truncated week, it's not a bad idea to go out and book some profits and just wait for the market to be kind enough to give you that dip to re-enter.
So that's the texture, that's the structure you're looking at. How much of a pullback are you expecting, Kush, at least on the Nifty 50 and the Nifty Bank as well, because you've gotten calls on both?
Great question. See, what's happening is that every time index is moving about 200 to 300% higher, the supports are shifting upwards. That's on the Nifty. So, earlier 23,000, then we saw that base on 23,300, and now we're seeing a strong put base on the 23,500
Can
level.
we get?
And hence, I think 23,500 to 23,400, is the zone where if you do get that kind of a drop, you should look to accumulate. So about 300, 350 points from here, maybe a little less would also do. On the Bank Nifty, about 53,000, 53,200 kind of levels. Now, the supports are shifting higher. 52,000, 52,500 have a good put base on the Bank Nifty. So somewhere close to 53,000 should be a good pullback to re-enter. Let me just reiterate, this is from a very near-term perspective. From a medium-term perspective, as I said, the tide seems to have turned now.
Right. Kush, you did talk about profit booking, but any counters that are still looking attractive to you right now that you would want to go ahead and buy?
Oh, absolutely. The texture of the market is such that, you've seen a lot of action, on the broader end of the spectrum as well. The stock-specific action isn't abating, right? Now, while we've seen in the past, if you skip the whole of last year, even before we've seen, while the market could, be in a place, the stocks could do their own thing and, move higher. So even now, I've got two calls and both of them on the long side, despite the kind of, mildly cautious view, or a near-term cautious view on the Nifty and the Bank Nifty. Apollo Hospitals, we've discussed this stock in the past, continues to do well. So that's a reiteration of a call. 71, 40, 70, 300 are your targets. 68, 70 is where you place that stop loss. So yeah, good moves on this one. Will continue to do well going forward as well. From the banking space, I've got City Union Bank. Again, like most of the pack, this too has done well on the back of good volumes. 200-day moving average taken out, golden crossover, of the smaller averages. It's got a few things going for it. So 182, 188 are your targets. 172 is where you place that stop loss.
Right. Kush, what's your view with regards to fertilizers and chemicals, Travancore? Because, in the past few days, it has silently moved. In the past 5 days, it's gained over 25%. And today, we are seeing significant up moves. It's up by about 13% right now. 1 month also, it's fairly done well, up by about 20%. But do you think now it's the time to book profits, or do you think this momentum will sustain?
Mahima, you're referring to fact, right?
Correct.
Sure. So, in fact, if you recall, we've been bullish on this space for a while now. Chambal Fertilizers, was a call that we've initiated about 10, 15 days ago. Coromandel also was one of the picks that, we've discussed. Fact was one stock which hadn't really participated. So, if you ask me, this is more of a catch-up rally. And despite the kind of 13% up move, it doesn't, deter me, at least technically, and given that this is more of a catch-up move, that, you could still perhaps go out and look to accumulate. fact, the target on the upside is 810. Once that is taken out, you're looking at an 880 kind of a level as well. Stop loss comes in at 710. So despite this kind of up move, there is still some upside to be had. Because if you look at something like a Chambal, made a low somewhere, early this year, end of Jan, whereas fact made a low just recently, right? I mean, about a month or so ago, maybe less. So I think there is a lot of catch up to do. The fact, I won't be surprised to see move higher to 880 levels, but I still prefer the likes of Chambal in this case.
Okay, and what about your reading with respect to where Nucleus Software is concerned? Because even that stock is gaining significantly in trade today.
Nucleus Software, right?
Yes.
I'm afraid I'm having some. Okay, got it. Got it. I was having some difficulty, getting the charts up. But no, this one has consolidated for a while. Was seeing a bit of an up move. Now, a couple of things in terms of resistance going for it. One, the 1000 level will start acting as a psychological and also a technical resistance. From a short-term perspective, the stock is overheated. So the best way to play this would be to buy on declines, where a slip towards 950, 945 zone should be taken as an opportunity to accumulate. If you have these stocks or Nucleus Software in particular, not a bad idea to continue to hold because there's momentum, but fresh positions aren't warranted because of the risk reward ratio. So a pullback towards 945, 950 should be taken as an opportunity to accumulate afresh.
Kush, within the Nifty Bank, you've got several large movers, and would be a real miss if I didn't ask you your views with regard to some of them. And ICICI Bank is up 3.5%, and SBI is up 3.5%, Kotak is up 3%. On some of these large gainers, and an HDFC also up 2%. What's the view like? And and Axis is also up 2.9 odd %. So some big gainers, and these are large cap banks as well. These aren't small in size either, and therefore the move is significant.
So Harsh, I mean, if you talk specifically about HDFC Bank, we know that the stock hasn't done practically anything for the last 4.5 years, 5 years, and all sorts of reasons, technical, fundamental, money supply, what have you, all sorts of reasons can be attributed. So I think the upside to this one in terms of a catch-up rally with some of its peers is fairly high. So there's a good possibility that you could see levels of 2,000, 2,100 in the coming months on HDFC Bank. And as you'll recall, in the recent past, we've discussed that if you want to stay within the banking space, it's not a bad idea to stay with HDFC and ICICIs of the world, and in PSUs, perhaps something like an SBI and a Canara Bank. So continue holding on to these. There isn't anything yet suggesting that the momentum's taken out of these names. Perhaps you might want to pick and choose, where Kotak is also playing a catch-up, but I would still prefer an ICICI over a Kotak. SBI from the PSU pack. Also, let's remember one thing, that if the FII money is coming back, and there are very early signs of it, but if it is coming back, we know that banking, especially the likes of HDFC, ICICI, and SBI, will be one of the key beneficiaries of that. So with that point also going to their credit, of course it's a big question, but if that does happen, then there is still a lot of room and a lot of money to be made on the upside. And let's not forget the margin of safety angle as well in times of volatility.
Kush, you've given us a view from a 6-month perspective. How should we look at it from a trader perspective? So are these good levels to buy at this point from a trading perspective?
Let's say, if you have a week or a 15-day kind of a time frame, then yes, I would say, you might want to perhaps wait it out just a bit, because when I talk about Bank Nifty slipping, let's say about 1,000, maybe 1,500 points, and purely on account of profit booking, obviously some of these names will also cool off, right? So then, it's a good idea to buy these also on declines, as is the case with Bank Nifty. So a dip towards 1880, 50, that zone on HDFC Bank, a dip towards 1375 kind of levels on ICICI Bank, that would be a good level to accumulate. While they aren't particularly overheated, but yes, with the kind of sharp move that we've seen over the last 5-10 sessions, and some cooling off, which is very likely on the Bank Nifty, these heavyweights will for sure participate. So if you're a trader with a view for a week, maybe 10 days, then you should wait it out and use declines to accumulate rather than go and right now, because the risk reward ratio will not be favorable buying at the current.
On a day when markets are certainly showing plenty of zing, Mahima, we have an NDTV Profit exclusive. Of course, we have the global trade war, which is heating up. There is a rising trend of FDI interest in India as well, and that's one of the reasons why banks are perked up. We're seeing continuous flow from an FDI perspective. But what's the possibility of setting up manufacturing base in India? My colleague Shrimi joins us with more perspective on this count. Shrimi.
Yeah, so what we have been given to understand that government has received 20 plus foreign direct investment queries in past 2 months, and this is mainly to set up manufacturing base in India, and these queries are spanning across sectors but mainly into chemicals, electronics, textile, and they are saying that government is examining these proposals, and in fact notably some of these proposals, at least 7 to 8 such proposals are related to joint venture with China backing investment. So they are saying that they are looking into those, and they are getting a lot of these queries as far as joint ventures are also concerned. Now 2-3 scenarios are at play is what sources indicating us. Is one is clearly that all these foreign players are kind of restructuring their investment strategy for India, and kind of looking at how to sort of diversify their supply chain as far as Indian market is concerned, and a couple of reasons for that. One is of course the kind of tariff situation we have. India has competitive advantage over global peers, and the kind of policy we are offering to these companies, particularly in the form of PLI schemes, that is giving lot of certainty for these foreign players to come to India, set up their manufacturing base here, and also remember the way we are handling this entire tariff situation with the US. We have already started talking on the bilateral trade agreement. The talks are ongoing, and in fact we are hoping to sort of conclude that deal by September, October. So that is giving lot of certainty as far as global companies are concerned, and they are trying to sort of leverage the way we are handling it, and it's very cost effective for these companies also to have a very ecosystem, and indicating that we are better positioned if you compare us from other markets like Vietnam, Bangladesh, Taiwan. So yes, the indication is coming at this point of time that they are realigning this entire investment strategy, and that will be reflected in the coming months.
All right, Shrimi, thank you so much for breaking that down for us. And in fact, the highlight and takeaway from what Shrimi said, and a lot of analysts have also been saying this, that India is much better positioned as compared to other countries where tariffs are concerned. But, circling back to what we were talking about, that is the banking space. We've talked about a couple of factors that are playing in favor of bank. First of all, valuations, and you've always advocated as to how valuations are lowest right now, for banks. Considering a rate cut, and we're also penciling in that FY26 overall is going to be very good for financials, right? Do you think that this kind of up moves is kind of already penciling in, because we're also seeing a lot of FIs also buying in ICICI Bank, HDFC Bank, Axis, as well as SBI as well. Do you think that these factors are now getting penciled in, and this momentum should, after a given point of time, stop? And if yes, when?
Well, in fact, Mahima, it's the reverse. FY26 may actually be a tepid year for banks in terms of earnings, because what you will see is you will see yields, which is the loan rates come down due to the repo rate cut. But you may see deposits start to reprice in a slower fashion. We had Ashwini Kumar Tiwari, who came in the morning, SBI Managing Director, and he spoke about this trend. So you may actually see the first half of this year be slower where banks are concerned in terms of the way in which the numbers start adding up. It may actually be back-ended. Maybe the latter half of this year may start to see better numbers where banks are concerned. But two things I believe driving the flows today, and we'll also ask our guests on the show, but the sense is that two things driving flows. One is valuation comfort is available there, and therefore likely that is one piece. The other piece is the FII interest right now. Last couple of days we've seen strong FII buy flows. Maybe not 500 million, but roughly about there, 3 to 4,000 crore rupees of buying by FIIs.
Right.
And generally they'll opt for pockets which are under-owned at this point by FIIs themselves. And right now banks are in that sense, in relative terms, under-owned by FIIs, and therefore they are just shoring back ownership. But let me bring in Vineet Bulinskar for exactly this. Vineet, welcome, good afternoon, thanks for joining us. Opportune time. It's a day when the Bank Nifty is rallied. It's a great question by Mahima. What's your sense? What's driving the Bank Nifty outperformance from a fundamental perspective? Vineet, I'm not sure. I believe you're on mute.
So over the last couple of months, we have been writing reports only on banks, and we believe that contrary to the market opinion, banks are going to do relatively better. And it's already being visible on the screen. So, my quick take is that, you have to understand that China is the fundamental enemy of USA. And it doesn't stem from economic positioning itself. It generates from, your fundamental security concerns. Because if everything is going to be made in China, then tomorrow China will have a hold on US. So Trump is breaking away from that. And given the cost structures of the United States, you cannot have cheap production, and that has to be outsourced. And most of it as an alternative to China is going to be India. Okay, so that is what we are seeing happening, and that is also being played out in the FDIs that are being inquiries that are coming in. We are also on verge of signing an agreement with them. We already signed a framework. 3 countries are in advanced negotiations: South Korea, Japan, and India. And clearly, US understands who are foes and who are enemies, and that is going to be a very big driver for an economy. So from that perspective, if you see banks, interest costs are down, liquidity is injected. We have got abysmal valuation multiples. ROEs are very high. NPAs are, at cyclical lows. And, with the policies of the government on taxation, consumption boom in India is going to grow significantly. So, you might have slight reduction in NIMs, compressing, but, we'll make up for by the growth in numbers and growth in, the GDP growth that will take place through all these initiatives on manufacturing.
That's a very comprehensive view, Vinny. Thanks for that. And continuing with the banking theme, following last week's 25 basis points repo rate cut by RBI, SBI has also reduced their repo-linked lending rates. Earlier in the day, we also spoke to Ashwini Kumar Tiwari, Managing Director at SBI, about how this will impact the margins. Listening.
So existing loans, as I mentioned, those which are linked to the external benchmark, which is repo rate, has immediately happened. We also announced on 15th of April, external benchmark rate cut of 25 basis points, which is the RBI's reduction. So that has already happened. Now, in case of deposits, as I mentioned, the rate cut which has happened is applicable to new deposits. Older deposits will continue at the contracted rate. And as they mature and are brought again for depositing again, that is the time the reduced rate will kick in. So therefore, there will always be a lag in case of rate cut in terms of the deposit rates getting priced in, and therefore there will be some initial pressure on margins.
I always love listening to Mr. Tiwari, one of the finest minds within the banking space. But we also spoke with IDFC First Bank, completely different peg on that count because they've approved a fundraise of 7,500 odd crore. Warburg, Adia coming in. It's interesting to see, Mahima, that foreign investors are now interested in banks in a big way. Right. This is of course a direct vindication of Indian banks and possibly one pocket which they believe is well valued from a long-term perspective. But let's listen into what he had to say with regard to the next stage of growth for IDFC First Bank.
All of these raises have all been above book value per share. All. So every one of them adds to book value per share because you're giving new shares at a higher price than the book value. So net, the book value per share after this transaction will touch close to 53. But that's one point. That's one part of the story. Now, I think a more fundamental question should be, that why you're raising capital, so much capital, and why you're raising so frequent capital. Is that the question simply? I need people to understand this basic fact that if you look for a bank which is like 30 years, 35 years in existence, they're already running to peak profitability. So their capital is almost equal to the return on equity. The growth is almost equal to return on equity. They can keep on forever. But for our bank, starting from zero. So for a bank which has a zero return on equity to start with in 2018 or 19, so, right now, let me call it around maybe 7-ish or so, if you take out MFI impact. So your return on equity is 7, growth is 20, the gap has to come from capital. But the good news is that 0 has moved to 7. We believe 7 will come to 15 or 16 also. But it's a phase. Early stage bank, every bank starts low and then becomes, bank like ICICI or HDFC. Think about how ICICI raised capital 20 years ago. They raised $5 billion in 2005, $3 billion, something like that in 2005. That's one of the capital initial stage people raise.
Vineet, I wonder what you make of this. Something like an IDFC First. It's a small bank in relative terms, in terms of size. It's valued at around 1.1, 1.2 times price to book. Has demonstrated strong growth, has its set of challenges, but has been raising funds, and this is where the concern lies. It's been raising funds at 2 times price to book, 1.6, 1.7 times price to book, now raising at 1.1 times. Is that at all a concern? And just give us your views on the bank itself.
So, we have initiated a sell on IDFC Bank. And it is precisely for this reason that the amount of funds that they need to raise to meet capital adequacy and also to grow in the future and take into account the NPAs buildup that is there is very uncomforting for us. So we believe that equity dilution will lower the growth rate of the bank, and we think that the bank should be valued below 1 multiple given all these concerns that we have.
So that's the view with regards to IDFC First Bank. Vineet, in terms of shifting focus to the consumption space, we've seen a lot of notes coming in and talking about the high valuations versus growth not happening. And there was an interesting CLSA note saying that the growth versus the valuations at where these staples stand is completely detached. What are your views with respect to how consumption and especially FMCG staples will play out in FY26? Do you see some improving trends there, because we're expecting good monsoons? We're also expecting the benefits of tax rate cut coming in, plus inflationary pressure overhang which was there in FY25 overall is slowing down now. So even that will play its part, and price hikes have already been taken. So what's your view with respect to where these staples are concerned?
I think we have a positive construct on these, and we believe that they will do well. We like Devyani International among consumption themes. Your HOL looks very interesting. So these are a couple of names that we like. And while, the growth story is still not present, but, the macros are well in place. And then you'll have all these factors, connive together to build a growth story. So you have to be invested out here because, from this, you have nothing to lose from the current levels.
Okay, so that's the view with regards to where staples are concerned. With that, it's time to slip into a very short break, but stay tuned. We'll be right back on the other side to get you all the news and, of course, chatter behind the dealing room as well. Stay tuned.
India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had, in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers.
Welcome back. You're watching India Market Close here with us on NDTV Profit. Now, that time of the show where we bring to you everything that's happening with regard to all the chatter in dealing rooms. And this is, of course, our daily segment, Heard on the Street, which Somi does. Somi, what is it that you're hearing? And again, one more time, you've got us a hit with regard to IDFC first. So, yes.
Well, as our lower band was saying that bulls are taking charge, I have a negative news to start off with first, and that's on Maruti Suzuki. What dealers are indicating is that the domestic institutional investors have been selling shares of Maruti at higher levels. Whatever the rise we have seen for the shares, every rise is being sold on, is what the dealers are indicating ahead of the 4th quarter numbers. The company will be reporting its numbers next week, April 25th. So keep an eye out for Maruti in trade. JSPL is another interesting counter in trade today. Today morning, Morgan Stanley in fact had downgraded their rating to equal weight from overweight on JSPL and cut the target price to 900 rupees from 1200. But despite this, we are seeing such kind of an up move in the share price, around 4% up at one point of trade. And what dealers are indicating at this is that this 4% surge is on the back of the buying action that we are seeing from large HNIs on JSPL counter. When it comes to Axis Bank, the Nifty Bank Index has been in momentum for the last 4 trading sessions. It has been continuously gaining. But in the dealing room, Axis Bank is one name that has been standing out. Dealers are indicating that there are strong buy flows on both domestic and FII front when it comes to Axis Bank. And dealers are also saying that if you see in the last 6 months, Axis Bank has actually underperformed its larger peers, that is HDFC, ICICI and Kotak Mahindra Bank. And this could change going forward is what the dealers are indicating. And lastly, SpiceJet and Colgate India. Both these counters have been given a positional buy call on multiple dealing rooms today in broking firms that we are seeing for SpiceJet and Colgate. Now for SpiceJet, one of the logics given is the fact that the Q4 numbers are expected to be very strong for this company given the fact that there was higher air traffic and higher fares. And for Colgate, now if you remember ahead, we had got some Q4 updates that had come in, but the street is now saying that the fourth quarter numbers might not be as bad as they had feared when the operational updates had come in. So keep an eye out for Colgate as well in trade.
All right, thank you so much for that, Somit, and thank you so much for breaking that down for us as well. I'll go to Vineet. I think I'll take his view on SpiceJet versus Indigo, because today we had an interesting note which has in fact downgraded the price target for SpiceJet, and of course Indigo is going to be a better beneficiary where the entire Mahakumbh playout will take place. Vineet, your view with regards to where fundamentals are concerned for both of them, and of course Indigo versus SpiceJet.
So I think Indigo is self-explanatory. It's the market leader, maximum market share, and everything got going for it. But we don't think that SpiceJet is a sell. Our simple take on this is that the industry is here to stay. It is going to grow very aggressively. Airport additions in the country are only growing. International travel, domestic travel is picking up very aggressively. And what's more important is that, SpiceJet, while not cheap compared to Indigo, but they're doubling their fleet over the next couple of years. So earnings growth is going to go into hyper momentum over the next few quarters. And hence, we think that, at the kind of valuations that it is available at, we think that the market cap is very, very tiny for a player of national relevance. So I think definitely once it gets out of the woods, and it's on a better fundamental backing in terms of financial muscle, we think that the faster priced action will take place. Until then, I think this stock, you have very little downside out here, nothing to lose. And it's a very high risk, high gain play in a sector which has got significant tailwinds.
Okay, some interesting news coming in. Hi Vineet, hi Kush, on this whole sunscreen war. A little bit of an aside, but both are listed companies. HUL and Honasa is what I'm talking about. So I don't know if people have followed the story, but HUL and Honasa have been fighting online on social media over a sunscreen ad. And here the Delhi High Court seems to have ruled in Honasa's favor. So the Delhi court order says that HUL in its ad should say some sellers instead of online bestseller. They have to remove the light yellow orange color in packaging and use any other color that is not close to Derma Company, that is the product for Honasa. They've ordered HUL to discontinue their ad campaign and asked them to remove all online ads within 24 hours and remove the hoardings within 48 hours. There's also a hearing in the Bombay High Court, so we'll have to wait and see what happens. But just quickly, curious to see what's happening with the stock of both those companies, HUL and Honasa. And of course, not massively stock moving news for either, but interesting from a Honasa point of view that is taking on a giant like HUL. This is a space that you're tracking very closely, Mahima, and it gets very heated and competitive.
Yeah, absolutely. And in fact, especially in that the basket of especially cosmetics, it is getting extremely competitive, and it's not just the listed space, it's also the unlisted space which is giving a significant competition. And packaging is one such thing which kind of attracts the customer, and it's important to fight over that as well. So I think Honasa is completely, kind of taking over and making sure that something that is their product. But Derma company, if I'm not wrong, is an acquired product. It's not originally a Honasa manufacturer owned product. But yeah, so that is how things are heating up right now and how competition is playing out as well.
Even if it's acquired, it's okay. It's a win for Honasa in this case. Today's, win for anyone who stayed invested in this market, I think, Harsh. That's the biggest story.
Yes,
just the point, because you track banks so closely. Just firing up on banks ahead of the results. I'm just wondering if Street is setting itself up for a little bit of a letdown. If there's any kind of a miss on the numbers we'll see on Saturday.
Well, that could be a possibility, Tamanna, and we've just been discussing that on the show as well. That could be a possibility, but it's the very strong FI buy number which is likely driving the way stocks are moving, and it's also the fact that some of these counters versus historical are trading at a decent discount as well, and therefore maybe to some extent warranted. We spoke with Vineet on this as well. He was also super bullish with regard to how banks are concerned. So from a medium-term perspective, surely it looks decent. Kush, not so positive from a short-term perspective. So that's the brief summary of the views we've taken over the last half an hour for you as well as everyone joining us.
Yeah, that recap is important. I'm just wondering how high can an ICICI Bank or HDFC go post this, and whether, in the rotational play, what's next. Kush, let me come to you on that piece. Because even as the bank rally is leading the entire market, the broader indices also looking fairly decent. Would you say that there is space for a recovery in IT at any quarters? Remember, we might hear from Infosys in another hour or so, less than an hour or so. I mean, sometimes it comes in right a couple of minutes before close. But do you think IT is set to join the rally at any point, the Nifty, IT, or any of the individual stocks?
Hi, Tamanna. Why, Tamanna? I mean, why do we want to dabble in a sector which, if I recall correctly, yesterday Neeraj said, I think there are a lot of mixed views on the street across all sectors, but one trade is consistent, which is sell IT, right?
No, but can I tell you something, Kush? There are enough people out there who are saying that the worst may have been priced in. The deal pipelines, if you look at it, are not that bad. And I mean, the whole space is shaky on the basis of management guidance. One could argue that the management is being very, very sanguine by saying that it could be terrible. They might surprise on the upside.
So Tamanna, even I've spoken to some of those candidates, some of those investors who say that this is deep value. They've been they've been selling off for some time now, and this is a good time to buy and hold. I agree if you have a 12, 18 month, maybe 24 month kind of a time horizon, right? Because how long could these stocks be beaten down? That is one question. But if you ask me from a near-term perspective and from a purely technical perspective, I would believe that once I see any kind of price action, right now we've seen a bout of recovery, right? It's not that that recovery hasn't come about, but if you recall, what we've seen is there's been bounce from oversold territories, and that's been taken as an opportunity to sell further. So Infosys, TCSs of the world haven't really impressed, at least on terms of price action. Once some key levels being taken out, let's say 1500 on Infosys, maybe 3450 on TCS. Once you see that meaningful, sustainable bounce, is when they make a good candidate for trade. At least if you want to trade momentum. Other than that, you've got a lot of other sectors which are at play. So if I had capital to deploy, I wouldn't deploy them in the IT names for now. And hope for momentum rather than actually play where the momentum is, which is banks, some cement names, healthcare space, and within that hospitals. So I would wait and watch, but they wouldn't make a trading bet for me just on the basis of them being oversold.
Well, vehemently making a case that it's not a trading bet, Kush. But Vineet, what's your take? Would you go contra at this point?
On which stock?
On IT as a sector.
Oh, I would not touch it even with a barge pole.
Okay.
Sorry, so Vineet, I'd like you to elaborate a little bit on that. So what would you like to see in terms of sensing that there is a recovery at play? Would you want growth to come back significantly, or would you in general not want to touch it because these are slow growing giants?
So I just want to highlight a couple of things that are going on. Is that we build models for all the IT companies, though we've not released reports on them. Today they are at fair value, and if you would be wanting to buy stocks, you want to buy them lower than fair value, at least 20%, right? So I'm looking at a point in time where they're 20% cheaper to look to buy them. Number one. Number two, if you see the numbers that are coming out, slowing growth, right? It just doesn't pick up. Third thing is that, AI has become so part of everyone's life. There is no need for IT, if I may say that. You just need managers who can build you flows, and for that you don't need IT. And the first hit that is going to come in the business consultancy space, and it will trickle down to the IT consultancy space, because employing a $100,000 person as an IT consultant in-house, and rather than outsourcing that to a IT consultancy, okay, and both are going to be using ChatGPT and LLMs to drive solutions. There is no need of outsourcing that activity anymore. So I believe that there's a fundamental shift in how business is going to be done, and we are going to see several downgrades, degrades, unless and until these companies innovate. And sadly, they have not, despite having billions of dollars of reserves and cash flow generation, they've not even tried to build a product. It's very saddening at that end.
So this is a sector, Tamanna, which is down 33%. Vineet says he won't touch it till it goes down another 20. Just kind of putting it out there, and thereafter he'll consider it, because they haven't done the right amount of or the right type of investing over the last many years of the billions of dollars of cash flow that they make. Just kind of summing it all up there.
I mean, I don't know if there's a contrarian view at all over there, Vineet, but you've said it well. Perhaps the worst is behind us on IT. Vineet and Kush definitely do not agree. But let's focus on the stock of the day. ABB is in focus after the global business reported stronger than expected India order growth in its first quarter. Anushi is telling us why ABB is buzzing today.
Right, so what we are seeing for ABB India is the results for the first quarter of ABB Group, and this is the first quarter results that we are looking at. The company follows a Jan to December calendar year pattern. So what has happened is that the ABB Group, for its India business, it has reported a 1% of a growth. Do note that the expectation for a negative growth, so anything in positive is a big positive for ABB's prospects in terms of where the order inflows are concerned. So a big positive on this side. But talking about the ABB other numbers as well in terms of how the revenue has fared, how the EBITDA margins have. If you look at the total revenue, they reported a growth of around 3% at $7,935 million, which is lower than the guidance of about mid single digit that the company had given in its earlier quarter. So while this is a factor that has been because of the kind of global environment that there is building on, it's the EBITDA margin number which is another standout for the quarter. Now EBITDA margins have seen about stood at 20.2%, seeing an improvement of over 200 bips, and this is above the guidance given, where the management had expected that the margins would remain majorly stable. This was led by higher pricing, better pricing environment as well. So this was a big thumbs up, along with what the order inflow prospects were for the company. Overall orders, if we see, they reported about a 5% growth at $9,213 million. But let's also take a look of how the company's ABB Group's order inflows have fared as compared to ABB India. So we are seeing a similar kind of a trend in the past quarters as well, where ABB Group, last quarter we saw about a minus 21% of a dip in its order inflows, when the ABB India had reported about a 14% of a dip, while if you look at the other 3 quarters wherein they had seen a positive growth, it's a higher than expected growth that we had seen for ABB India. This is 9% against 11% of a growth that we are seeing at. So focus would be now on the first quarter, wherein ABB India may see higher order inflow growth. That is something that we should be watching out for. Another factor that should be considered is the company now plans to spin off its robotics division, which is expected to be listed in the second quarter of FY26. So that is something that we should be looking forward on how the robotics business would be. Also, the company now has maintained its CY 2025 outlook. Majority of the factors have remained steady, which includes the likes of revenue growth being in the mid-single digit, positive book-to-bill ratio being there, and improvement in the EBITDA margins. However, they did state that the global environment is something where there is more uncertainty building on. So that is one factor that should be considered. But overall, a net positive result that we are looking at, of course, the main focus being on the order inflow pictures for ABB India. That's the reason why the stock is up in trade today.
Right. Thank you so much for giving us that information, Anushi. Vineet, I'll take this up with you. Interesting company. You know, over the past 5 years, the growth CAGR for the company has been over 40%. In terms of dividend payout also, it's a good company to have in your portfolio. How do you see growth coming in for ABB India, as well as how do you compare this to the likes of something like a Siemens? Vineet, I think you're on mute.
Both these stocks have their own, growth metrics, and I think both should be a part of your portfolio. High growth rates will continue, and I think you can see steady compounding of these stocks in your portfolio. So my view is to go buy both these stocks together.
Sorry, quick follow-up. Do you also like a Siemens, or between an ABB and a Siemens? Also. Is there a preference you have?
No, as I said, it becomes a part of a portfolio where you add both.
Okay. Point taken. Also, you've got a couple of stocks which are really flying in trade. You have Fusion Micro within the lending basket. You also have an SBI Cards, where we had a positive view coming through, some possibility of some of the overhang with regard to unsecured going away. Vineet, I wonder whether you would try to play that, because a Fusion Micro and Equitas and SBI Cards are some big movers in trade today. Is this a start of a potential opportunity where you could see 20-30% returns in a very short period of time? If things were to improve, would you venture in that angle of things?
So, you talk from IndusInd Bank to Credit Grameen and all the other players. All of them are, of the opinion that things will look better from now onwards. Number one. Number two, the government scheme, I forget the exact name, is providing them significant insurance from, the losses that accrue from these microfinance lending. So to that extent, I think the entire pack of SFBs and these lenders are due for a re-rating. Their valuations are abysmal. And typically what happens is that you have a good growth period, then you have a slam dunk, which they've gone through. And now they're going to pick up again. So they'll have another 2.5 years of cycle. It may not roll out this quarter, it may roll out from next quarter, but definitely well positioned to benefit from this. So good to have a small allocation, 1-2% of your portfolio to one of your favorite stocks from this segment.
I'm loving how credit quality concerns have not just ebbed, but seem to have vanished for this entire microfinance space, which was the biggest talking point not less than 3-4 weeks ago. Just follow up on that, Vineet. What do you think? Is there any factual reason for those concerns to have ebbed? Was it not as bad as was expected, or right now in relative terms, in a rotational play, the space is looking better?
So as I mentioned, most of these players are going in for the government-backed insurance scheme, which protects them from the adverse effects of NPAs from this segment. And that reduces a large amount of risk of lending to these segments. So that takes a lot of the asset quality concerns away, and hence you're seeing a re-rating take place.
Okay, so government intervention has sort of moved in. All right, let me go across to, I think, a stock which is definitely a bull versus bear case. You should hear both sides of the story. If you've heard to Kush and Vineet so far, you've definitely heard the bear case. But I'm going across to Puneet to talk about Wipro. Puneet, what is the bull case, if any, for a Wipro today?
Well, there are a few points we've put together, but a bear versus bearish case is something that I would like to rename this particular segment. Not too much positives essentially in this particular results for Wipro. While the large deal wins were a key positive, and that's the first bull case specifically, up 17% on a year-on-year basis as well. They were largely expected because of the new, UK insurance deal that the company had won a couple of months ago. So it was expected to come in and also boost the revenue as well as the EBIT margins, not to be, at least in this particular result. We've seen, the deal wins not translating into any kind of revenue growth, and that's the first bear case essentially. If we can move on and look at the second key bull and bear case, management has mentioned that they're expecting revenue to recover in H2 specifically of FY26. Europe is something that they are positive on going forward, so something to watch out for. But sequential guidance in Q1 of FY26 is a huge negative. Negative 3.5 to negative 1.5% growth is what's anticipated in Q1 of FY26. Brokerages had penciled in a negative 1 to a positive 1% growth actually. So it's a big negative there, which essentially has triggered most brokerages to come out and actually mention that FY26 might be a year where the company might actually not grow revenue for the third consecutive time. When you look at the third bull and bear case, they are endeavoring to maintain margins in a narrow range, and that will give some solace to investors going forward. But they are expecting clients to take a more cautious approach going forward on consumer discretionary spending, and hence that will lead to project delays as well. Finally, in terms of valuations, currently at 17 times price to earnings for FY27. Now, that is actually the lowest amongst the large cap players, but there is no growth in sight. So essentially, it might not actually be a value play, but a value trap maybe. And brokerages are also penciling in that aspect. They are saying that this could be, of course, the third consecutive year of revenue decline, and margins, while improving from the 15 to 16% to going all the way to 17% for the last 2 quarters. The playbook for Wipro, might be in terms of growth, and that's currently not in sight. So overall, there are a few aspects moving around for Wipro, but not too many on the positives.
Okay, thanks for that, Puneet. The other one which is really moving in trade is Sonata Software. Puneet, would love your view on that as well. But we'll do that in just a minute. Let me quickly go across to Vineet Bulinshkar. Vineet, I know you're not in favor of the large cap IT, but how would you play IT therefore at this point? You can't completely ignore it. Would you play through mid-small cap? Are there any specific counters where value has started to emerge within the mid-small cap space? Or would it be ER&D, or would you ignore it completely?
So Sonata Software, by virtue of its performance, it's a very low-lying stock and very under the radar, and they've generally been performing very well. So that is where the stock would lie my interest. Persistent is another stock which is very, very AI heavy, and they've got good credentials around that, is what I would be looking at. But apart from these, I would tend to stay away from the IT back.
How many ways Vineet will find to say, nahi lena hai IT bhai. So I think he's very clear on it. Okay, what's happening with Sonata? Let's get the update from Puneet.
Well, yeah, thanks for that. So, it's lowered its Q4 FY25 estimate, and that's because Sonata's largest client has essentially, pulled back a bit in this particular quarter. International revenues is expected to be lower in Q4, and revenue is expected to decline higher than what the company had guided. They'd guided for a 3.5% fall in revenue in Q4 of FY25. It might be higher now because of this aspect. Now, essentially, the largest client could be Microsoft, and LTIMindtree as well as Persistent are vendors of Microsoft. So we might see some impact on those stocks as well. We saw that in the morning. That's one key aspect. International revenue is roughly 25% for Sonata Software and is a high margin business as well. So that's one of the key negatives. While the stock has recovered from roughly about a fall of 12% today to roughly between 5 to 6% now, I think there are more questions in this particular quarter specifically. Now, in Q3, they had mentioned that the TMT vertical is, ramping down because of clients having essentially pausing the expenses. But this new update, which has come just last night, of its largest client pulling back a bit in this particular quarter is largely a negative.
So that that's bound to happen. That's bound to happen at tough global conditions prevail. So we've been talking about a sector which is down in the dumps. Everything else is up and about. We're above the 23,800 mark, staying there. Bulls are firmly in charge. We're going to take a very short break. We're going to come back and tell you what positions you need to put into place for a long weekend ahead. I will get you more on that. Meanwhile, Kush and Vineet, thank you so much for joining us on this leg. We'll be back with a fresh analysis and views after this very short break.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
The first stock on the list is it's IGL now. If you see the stock that has perked up around 4% in trade, and this is largely on the back of the buzz that is on the street that the company might announce a price hike of anywhere between 3 to 4 rupees from the 1st of April. Now this might as well happen in phases, so keep an eye out for IGL. Now this stock had to, the company had in fact had to take a price hike post the Delhi election because the cost of gas had increased for them, and because of that the margins had come down, but they had not taken any price hike so far. So the street is expecting a price hike announcement to come in, which will be effective from the 1st of April, and it could be around 3 to 4 rupees, and it could well be implemented in phases. So keep an eye out for IGL.
All packaged food companies should shut down. Packaged food as an industry have been telling us half-truth. Our mission is to rebuild the world's trust in its food. That's why if half-truths are the problem, then the whole truth has to be the solution.
So these half-truths that you're talking about, Shashank, did you encounter them in your first big job?
They're saying no added sugar, but it has a ton of sugar in it. Replaced my cola with a healthy fruit juice, only to find out it has the exact same amount of sugar as my cola.
How your own personal journey has led to the creation of this idea.
Yeah, I was a super fat obese kid and I lost weight. In 3 years, 30 kgs came back.
How many times a day would you have your own products?
Oh, at least 2.
Any of your products, would you say a meal replacement?
If you have 1.5 protein bars, then it will become a meal replacement, not 1 bar.
Dal chawal or protein bar?
Dal chawal.
The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have 2 credible credit rating agencies on March 4th coming and downgrading the
Welcome back. Bulls firmly in charge in this, thank God it's Thursday, and let's celebrate the long weekend trading session that you're seeing. It's just been a fantastic move up through the day. I just want to pull up the Nifty intraday for a second just to give you a sense of the kind of very tepid start that we had. But once bulls took charge, there is really no turning back. 23,850 just crossed the 23,600, then 23,700 mark, and now 23,850 with such ease is astonishing. What's leading it? Banks are leading it, no doubt. ICICI all-time highs, HDFC, public sector banks coming in. So are your small finance banks, which is interesting. IT languishing out on the sidelines, but there has been an improvement even there, no doubt. To speak more on what to expect in the coming week, I'm joined now by Sandeep Agarwal, fund manager and co-founder Savilo Investment Manager. Sandeep, very good afternoon to you. The problem is that we've seen this story play out before, a bear cycle and then few sessions of euphoria. Question that comes to mind is that are we seeing short covering? Are we seeing an undersold market getting corrected, or are we seeing now a bull leg of the rally that will continue for some time? You're on mute, Sandeep.
Yeah, hi. Thanks, and thanks for having me on the show. So, I have a very different perspective. Maybe, not everyone will agree, but I will put my thoughts here. So, I believe that when COVID happened, then first time the whole world started looking that, their supply chains getting concentrated in one country in the world is not good for them. And they all started looking for options. And I think that was the reason that in post-COVID, you saw a lot of mid-cap and small-cap companies reporting good profits, good profit margin, good growth in profit, more actually on the improvement on the margin rather than on revenue growth, because there were a lot of restrictions to import to avoid the dumping of the products in the country, and also a lot of European, and I'm telling you first-hand experience, I've met many corporates, the exports have gone through the roof to Europe and US. And that was the reason that the market did so well post-COVID. I think this is a second, and this is a much bigger jolt than the earlier one. And this time, while it may temporarily look very scary, but I believe that this will do wonders for the country, because if you see the pre-tariff war started, the GDP estimates for all the leading economies in the world, and the gap between India and them was already stark. And now if you see the revised estimates, India's GDP estimates has cut by 20 to 30 bips, which is like 5% on the base. But if you see other economies in the world, the cut is like 30-35%. So we are become more attractive than anyone else in the world after this tariff. And I think this is a much bigger opportunity than what we saw post-COVID. So I think this time the whole world will agree to one thing, that you can't not be in India for your manufacturing and supply chain. And in turn, investors will also realize that we need to be in India. So I think we will see a flush of money coming to India in next few months. And I'm very optimistic in the market. I was not so optimistic in last 2 years, but now the way things are panning out, I think we are in for a golden decade kind of situation.
Wow, what a mood changer that is. I haven't heard you sounding so optimistic, Sandeep, like that. Rajesh Palvia also with us. Rajesh, are you feeling that mood as well?
The mood is already there on the prices, and the way Nifty has moved up 1,000 point in the last 5 days, that clearly shows that yes, everybody is now buying in the market, and now the broad-based buying action, which is clearly the indication that yes, this upward trajectory can extend further, and possibly Bank Nifty is just few points away from the all-time high trajectory. So I think that clearly shows that there is a confidence the sector where there is no impact of tariff volatility. I think banking and financial, I think that sector has clearly given us indication that market is ready to move further higher, and Nifty is also following the same behavior. So we believe that yes, possibly we may inch up or scale up to the level of 24,000 level in the continuation of this up move. And I think this positive trajectory will keep on continuing for some more week from here onwards.
Rajesh, with respect to Bank Nifty as well, what are the levels right now that you're observing? It's hardly a few points away from touching its life high. What are charts indicating to you right now?
So for Bank Nifty, clearly, I think the next target where we can see in next couple of days towards 55,000 and 55,500 as most of the private banks like ICICI Bank, HDFC Bank are now at all-time high trajectory. Again, the PSU banks also started participating in this upward momentum. I think SBI is also contributing to this rally, and we believe that we may see another 1,000-point rally can be there in Bank Nifty from here onward. So buy on dip would be the advice. Till Bank Nifty is holding above 53,600 mark, I think there is a possibility that 55,000 to 55,500 would be the next target in coming weeks.
Right, and from the basket of stocks that are seeing significant momentum in trade, what would you go ahead and buy right now?
So two stocks idea where we are focusing at this moment. One is from the insurance basket, that is SBI Life is looking very attractive. The way stock managed to give breakout of almost 10 to 15 week consolidation at the lower band, and now the breakout is clearly indicating that this stock can extend its gain. Even most of the insurance stocks are also contributing this upward momentum. So SBI Life, we are projecting target towards 1650 with stop loss of 1575. Another stock is Avenue Supermart. DMart is also looking bullish. The way stock has managed to recover all its losses from the October 2024. Now stock is managing to fill the bearish gap which was there in the stock weekly chart. Long built up is there in data. I think DMart can be looked at for buying side. Our target for near term perspective is 4460. Keep your stop loss around 4335.
Okay, so that's the view with regards to where Rajesh's picks are concerned. With respect to HDFC AMC, the numbers are just out and Harsh is taking a look at that. While he's taking a look at that, there are good amount of gains in terms of profit. The board has also declared a dividend of 90 per share. There is also total income, which is up by about 20 odd %. Net profit is up about 18 odd % for the counter. Harsh, if you've had the chance to take a look, what's the first cut? What is the read through right now?
Well, it looks like a very good set of numbers overall. 21% growth at a time and in a quarter when you've largely seen a correction overall. The stock reaction also quite decent in that sense, 2.5% higher. Sandeep, your view very quickly on the initial read through on the numbers.
So I think, as you rightly mentioned, the numbers are all around positive, and also, the way it has gone through time correction. So I think this whole space of AMC is coming back. Very hard to comment, although on one specific stock, but I would say that the whole AMC space is looking very good. The whole NBFC space and the banking space. So this whole BFSI space itself is looking very attractive.
And what about Rajesh? What about your take on charts? How does HDFC AMC look on charts?
Well, stock now managed to give breakout about 20-day, 50-day moving average. Even 20-day moving average has given a positive crossover to 50-day moving average. So it's a sign of strength on the near-term perspective. Stock managed to give breakout of its previous swing high also. I think if its stocks sustain above 4160 level, there is a chance that again stock can extend its gain towards 4260, even 4320 kind of level. So I think those who are already long in trade can hold the position with trailing stop loss of 4170.
Okay, so those are levels on an HDFC AMC, dividend of 90 rupees a share, a healthy 2% dividend yield at the current price as well. 18% profit growth is what the counter has seen for Q4 FY25. So overall, a decentish kind of a set. I also keen to understand the view, Rajesh, with regard to something like an Angel One. That was the other one which took out numbers or came out with numbers. What's the sense like on that one?
So after correction, stock is now consolidating near to its 20-day, 50-day moving average. It's almost consolidation of last 4-5 week, but the stock not managed to give breakout of this range. So 2450, 2500 is the key level on the higher side. Once stock crosses these level, then we can see good rally in the stock, and then maybe short covering would trigger about 2500 level, and then possible target towards 2650, 2700 we may see in short period of time. But till the time stock not crosses those level, I think some consolidation in range of 2250 to 2500 would be there, and possibly stock may attempt to give breakout on the higher side, as on the lower side we have seen accumulation activities already happening in this stock. So about 2500, I think we may see a sharp rally towards 2650 to 2700 level.
One has made a full recovery in that sense from the day's low, and that was the sense that despite the weak numbers, are we starting to see a bottom here is essentially the big question. Both our guests suggesting so. I want to also quickly mark out that HDFC AMC, in terms of the PAT estimate, was 606 crore. PAT has come in at 638 crore. So surely a beat on that count. Stock reaction also suggesting that. So just want to put it out there. It's a very strong set of numbers overall from HDFC AMC as well.
HDFC AMC is looking good. Just the point on Angel One, I mean, I wouldn't give it too much credit of some great bottom being found, because look at this, is a rising tide lifts all boats. Then I want to see what's happening with the 361 and Anand Rathi, all winners through the morning. And, the kind of move there, 361 come off actually its highs, but Anand Rathi started off well, now looking like it's in the dips. But, we've been talking about an interesting story and something which is clearly a setback for HUL. Setback legally in a very small segment, but nevertheless, it's a rivalry in India's evolving skincare market that has spilled into the courts. Honasa Consumer, the parent of brands like Mamaearth and the Derma company, has filed a lawsuit against Hindustan Unilever, alleging that a recent Lakme sunscreen campaign undermines the credibility of its own product. Now, what this the court has said, the Delhi High Court has said, is very interesting. Sesha, I believe the court has asked HUL not to use the same color on its packaging as the Honasa product?
Yeah, absolutely. So the Justice Amit Bansal has asked HUL to remove the light yellow and orange color in the packaging and rather use any other color that is not close to Honasa's Dermaco product. In fact, the court has also asked HUL to say some sellers instead of online best seller targeting directly Honasa's Dermaco product. Also, HUL has been asked to discontinue the current ad campaign, but they are allowed to run new ads with the modifications, and this include the both change in packaging as well as to say some seller instead of online best seller. They have also been asked to remove the online ads within 24 hours and remove all the physical hoardings within 48 hours. Further, the case is now dismissed, and also HUL has agreed not to press suit in Bombay High Court filed against Honasa.
Okay, Sesa, thank you so much for bringing us that information. Sandeep, I'll take your view with regards to this, of course, and in terms of how competition is faring out for all these players, where the entire skincare and cosmetics segment is concerned.
So, I believe that India is a very, very big market. We have a growing population, young population with increasing per capita income, and, everyone will fight tooth and nail to get their share of market share. So this is something which will intensify, and I think it will be the survival of the fittest. So very hard to, comment on specific developments, but we are seeing this for quite some time. And I believe that, the good thing is that, ultimately the consumer will be beneficiary, because more superior products at a better price will be the outcome of this thing. And I think that is what will happen finally. So I believe that, with such a big market, these are bound to happen, and this will only intensify from here.
I wonder what's happening in something like a CE Infosystems, absolutely flying in trade. Just picked it up right a couple of minutes back. Look at the spike on that stock. Rajesh, quick perspective with regard to this one, if you have any.
I think, yeah. So looking at the market momentum, I think CE Infosystem is also, participating in this rally, and the way stock has moved up, I think next target towards 1820, we may see in the continuation of this up move. So I think one can trail stop loss towards 1720 at this juncture to hold the position. I think 1800 to 1820 would be the next target for this.
Okay, Rajesh, let's quickly get your BTST ideas, if any. And this is the tricky bit. We're going into a 3-day break, so we'll have to wait and see what happens. But nevertheless, what are the ideas that you can share for the last 10 minutes or of trade?
So Eternal is looking attractive. The way stock has moved up and the breakout is already there on the near-term chart. So I think Eternal can be looked at for BTST perspective. Stock is comfortably holding above 20-50-day moving average and now negotiating with its previous swing high of March 2025. Long build-up is there in data. So I think one can buy this stock for 242 target. Keep your stop loss around 226.
Okay, so Eternal is the one idea that Rajesh is talking about as well. Another stock that has been buzzing is Vari. So it's very important to see the numbers that are going to come in, because that's going to be a big push, and anything that looks like a better than expected Q4 is going to have an outsized reaction. That's what we have seen with Vari Renewable. They've reported an 83% jump in its consolidated net profit at 93.76 crores. Earlier today, we spoke to the company's group head finance, Abhishek Parikh, about their quarter gone by and their order book. Most importantly, we asked him why margins are down despite such an amazing quarter.
So 3.2 gigawatt roughly in terms of revenue would at the run rate of 1.1 crore to 1.2 crore per gigawatt per megawatt would convert into somewhere around 3,500 to 4,000 crore worth of minimum revenue at this point in time. But as we move ahead, we also have a large pool of talent for the business development and sales team. And every quarter we have been building our order book as well. Like last quarter itself, we have seen one of the biggest orders coming up. And especially in the second half of this year, we have seen our order book building as good as 2.5 gigawatt worth of order. Especially in that, I would again mention that we got a single largest order of 2 gigawatt at a single location, which probably is one of the largest order by any solar EPC company at this moment. Our current order pipeline, the total bidding pipeline, which we call for our EPC revenue, is around 30 odd gigawatts. Which last year was somewhere around 20 odd gigawatts. So at 30 gigawatt of order book, we believe, we have a reasonable pie to look at, because we have been consistently maintaining our market share also. And year on year, our pipeline increases and we have seen the impact coming into our order book as well. So difficult to give an exact number, but I can tell you our order pipeline and our overall bidding pipeline has increased significantly in last 12 months.
Okay. All right, so order book is looking strong. The margins impacted to some extent by EPC input costs and employee costs as well, but Vari on a roll over here. Sandeep, is this a stock that you like?
So, we run a PMS, so very hard to comment on any stock specific, but I will say that, solar is something which we love a lot, but it is very, very expensive. So not within our philosophy or within our limits to buy any of them. So we are evaluating them consistently. If they come in our range of valuation, what we can give them, then probably we'll look at them. But right now, everything in solar looks very expensive to us.
That's the tricky bit about solar and clean energy, if I dare say. I mean, I'm not putting both in the same context, but Vari is a different story and Gensol is a different story. Not saying it in the same context, but for companies in that space that have the ability to make very big claims, then you have to actually see if they're running through and what their cash flows look like. But on the charts, meanwhile, Rajesh, are you liking Vari?
I have very limited data for this Vari Renewable, and I think looking at the technical, stock is in uptrend only, but still difficult to comment because limited chart for me. But looking at structure, 1060 is the key support area for near-term perspective. Which sustain over these level, I think really can extend further, and I think 1200.
So are you looking at energy? Are you looking at Vari Energy?
No, Wari Renewable.
Wari Renewable, right.
Yeah.
Okay.
So Wari Energy is having data, but Wari Renewable is having limited data.
Yeah. Okay. No issues at all. In terms of, Rajesh, let me also get your point on some of the auto companies right now. For EV plays going to be in focus. Auto again, one sector which was quite beaten down. Will we see that kind of recovery? How are you liking a Tata Motors, for example?
So after the corrective move, Tata Motor is trying to get some buying interest at lower level, but still structure is weak. Stock is trading below to all its near-term, short-term moving averages. But for near-term trading perspective, 600 is the key level on the downside. If it's able to defend this level in this market for next couple of days, I think some buying interest will emerge in this counter. And then on the higher side, the major supply zone, which is placed at around 650, 665, that may act as a resistance area for this pullback action. So those who are already long in trade or want to buy a stock should follow the stop loss at 600. Positional target 650, 660 we may see in the counter, as stock is already in oversold trajectory. So some recovery would be there in the stock in near-term perspective.
Sandeep, if I were to ask you to pick one sector which you believe will really outperform over the next 6 to 12 months, what would that be?
I think banking.
Okay. And your second best?
Second bet will be power.
Okay.
And third will be water treatment.
Understood. And how would QSR line up? Because you're seeing a restaurant brands up 7.5%. So quick perspective.
So a lot of QSR brands have become really attractive, right. and see, the India story is a long term and it will do well. So we are very, very actively looking at a lot of QSR names, and obviously, we can't buy them at what we want to pay, but we are little generous with them.
Earnings seasons have actually kicked off and Infosys is in focus. It's set to announce its results today, Q4 numbers. My colleague Puneet joins in with more details on that. Puneet?
Well, thanks for that. So Infosys will largely continue the subdued quarter that's expected for the large cap IT players. Revenues is expected to rise roughly about 1%, while EBIT margins will be under pressure and will fall by roughly about 70 to 150 basis points, and that's because of salary hike that's expected in this particular quarter. Because of that, net profit is expected to fall by 1% to come in at 6,716 crores. Now, apart from the margin hike, margin fall specifically in this particular quarter. We are anticipating the deal wins, as a number which is a key monitorable. Do note that Infosys only discloses the large deal wins, and in the previous quarter it was about $2.4 billion. Now that's actually fallen from roughly the 3 billion to 4 billion range for every quarter. So that will be one of the key numbers to watch out for. Attrition is expected to slightly inch up into this particular quarter as well. That will be another key monitorable. It was 13.7% in the previous quarter, and in the same time last year it was around 12.6%. So one more key monitorable there. Now going forward, I think one of the biggest numbers to watch out for will be the guidance. Brokerages anticipating a 2 to 5% constant currency revenue growth guidance for FY26. We've seen Wipro miss that by a mile, and TCS does not report that. So specifically that number will be one of the key ones to going forward, and if they are seeing any kind of project delays as well in this particular quarter, but largely a subdued number expected. We are expecting numbers to flash in the next 15 to 20 minutes, but press conference at 4:15 will be one of the key ones for any kind of forward commentary going forward as well.
All right, thank you for that, Puneet. So we'll wait and see what happens with Infosys. There was, I think 2 quarters ago, we were closing up the show and Infosys came in the last minute. So let's see if that happens. But a minute and a half ought to go, and what a week this has been. What a day it has been. Let's pull up the Nifty intraday to start with, the fun and games. The fireworks, I think, started about mid-morning and have continued unrelenting. Just look at this chart. I mean, it's a thing of beauty. You're close to the day's high, a little below the day's high perhaps, but 23,872. I just wonder if we have enough to push the 30 points that's left, or we're just being greedy. I saw so many tweets doing the round. I saw one saying that if the markets open another 3-4 hours, you'll cross, another 300 points today. So maybe good that we are shutting and leaving some firepower for the rest of the week. Let's pull up the heat map very quickly and show you what's been powering through the day, and it's all about the banks. Eternal, Zomato, coming in to, push through. Maybe a big weekend, some block deals coming into the picture, but Eternal is the street favorite today. ICICI Bank has hit an all-time high on its stock price, going strong, and overall it is the banks that is driving this. And RIL, it's been a very participatory kind of a bull push today, and it's pretty much just a Wipro and some of the IT pack, not even so many of the IT pack that are languishing. Wipro, because the guidance really to come in and say that we're going to degrow next quarter between 1.5% to 3.5%, a little doubt and little wonder that you've had that kind of an impact. But apart from a Wipro and some of the IT names, Harsh, is just all about the banks and ahead of an action-packed weekend for banks.
Yes, absolutely. Let's pull up the Nifty Bank on that count intraday and just look at the contributors here. Actually, let's freeze this. ICICI Bank, HDFC Bank together contributing 110 points on the index today. That's just those two counters alone. You couple that with a Kotak and an SBI that reaches nearly 150, along with maybe Axis, 160 to 170 positive points out of the 400 positive that we've closed at on the Nifty. That is significant. And therefore really packing a punch. Let's look at the intraday on the Nifty Bank, and you'll see that largely markets today were driven by the Nifty Bank. We've cooled off from the highs for sure. We've closed slightly lower. At one point we were up 54,407 is the high that we made on the Nifty Bank today. So that's how high we were. We've cooled off nearly 150 plus points from those highs. So something to keep in mind.